Morning, pre-tax profit forecast missing estimates, but they did announce a £300 million share buyback. So does that actually give them a boost on it?
Yes, indeed. So in terms of what we are trading around this morning, there are some new lines around tariffs, as Lizzie was just pointing out there, around autos, around some other sectors. So they are going to be firmly in focus. But how much of that is already in the price as we wait for April 2nd, waiting for the broader reciprocal tariffs? And the latest news flow around that has been that they could be a little lighter than expected. There could be breaks for some countries, in the words of President Trump. So where does that leave European equity markets? Well, we're waiting for most of them to open up this morning. So we are just starting to see some action then on the London market, up by 0.2%. The IBEX over in Spain is up by 0.4%. So we'll wait for a little bit more of the detail on these European equity markets to see where we end up. As I say, US futures are a little bit sluggish, so we are seeing a little bit of negativity sort of looming on the horizon. We're waiting for some data out from here in Europe. We'll get that IFO number a little bit later on. So current and future expectations for German business, that could be an interesting driver of trade a little bit later. We're filling in some blanks. The CAC 40 up by 0.3%. The Xetra DAX up by 0.3%. Waiting for that German data, waiting for further details around the tariff landscape and how that's going to stick then, Critty, to various sectors. What stands out to you this morning?
Yeah, absolutely. And the kicking off in terms of the biggest movers to the upside from an index contribution perspective, it's all about the oil space, although it is coming among some pretty broad gains. You can see it on the screen there, a pretty broad rally across the board. Energy, to me, really stands out. A lot of that's going to be driven by the numbers coming out of Shell. We'll dive into that in just a moment as well. Total, though, is coming up second. You're also seeing some of the luxury names as well outperform, and that has been a consistent theme when it comes to the outperformance of the French index in the last couple of days as well. And that's just one side. The downside, though, I'm seeing a lot of defense names. I'm seeing a lot of auto names. So it looks like Germany seems to be on the back foot.
Right. The broader sector story, though, is interesting because we've got autos and parts as the best performing sector, and no doubt there's some interesting detail underneath the hood. But it's interesting that on a day where we've got a sort of negative story around autos, European car sales, but maybe it's the fact that Tesla is so weak, and that maybe is creating some space for other European automakers to step forward and at least cushion the downside there. That could be an interesting line of inquiry to probe. And I know we've got Craig Trudell coming up on the programme a little bit later on to talk about that. But there's so much news flow, sort of cross currents that could be affecting the auto sector. It's hard to pin it down. We've had these lines from President Trump saying in the coming days we might get further tariffs on autos, but that doesn't seem to be weighing too much.
Yeah, so auto is the best performing sector, higher 0.9%. Every sector in the green, bar one, which is industrial goods and services, which of course has had lots of positive days because of defence boosts recently. But if we just dive into the auto sector, you've got Volkswagen up more than 1%, so are BMW and Renault's up 0.9%. We have mentioned Shell because of this announcement of raising its shareholder distributions to 40 to 50% of cash flow from operations. That's up from 30 to 40% previously. And indeed, those shares are up 1.2% this morning. We'd also mentioned Kingfisher. We wait for those shares to open. But as you say, more broadly, we had expected the FTSE 100 to underperform compared to the rest of Europe. And it's actually pretty much in line with the rest of the European indices at this point. Let's dive into some analysis of this now, shall we? Jerry Fowler, Head of European Equity Strategy and Global Derivative Strategy over at UBS, joins us around the table. Morning to you, Jerry. Are you betting that the US equity pullback is kind of done, that it's bottomed? Because, of course, that has been very much impacting the story in the rest of the world.
It really depends on policy uncertainty, because to some extent what precipitated this was just marginal weakness in earnings expectations through Q1, particularly for the Mag 7 companies, and broadly the rest of the market as well. But the scale of retracement we've seen is much more than that, and that's partly because valuations reflected a huge amount of growth premium that is being called into question with these downgrades, so the valuation is derated a lot, but also the policy uncertainty of 25% tariffs on, 25% tariffs off, 25% tariffs on, it's just too much. So obviously that just raises risk premium across the board. So at the moment, what we're seeing is that risk premium is coming down because Trump is talking in a more predictable way about the rollout of tariffs, potentially even scaling back the impact of them, at least initially, although there may still be a longer-term endgame in place. So while tariff implementation is likely impactful for stocks, the predictability of the implementation that we may be seeing come through next week might actually mean that the market gets a bit of a reprieve from the uncertainty. Okay. So at least a tactical rally, but we do think for a few good reasons it could be a sell the rally type market.
Yeah, because we've been debating how much you should listen to the optimism around headlines around, for example, that there might be a more measured approach when it comes to tariffs. When we look at the European side of this then, are you betting that the growth from the fiscal boost outweighs the tariff impact?
Yeah, it almost certainly does. So the tariff impact, we think, is around about 0.2% of GDP in Europe for about a 10% universal global tariff. So it's not particularly meaningful. It's all in 2025. It's all in the export sector. So it means it's reasonably stock specific to the companies that are exporting. But we're talking about upgrading GDP forecasts for 26 and 27 by 0.6 and 0.7%. So it's a bigger deal over the longer term that we're doing the stimulus in infrastructure, in defense spending. It will probably percolate across to confidence for the consumer as well. So it should matter more that Europe might have 2% real GDP growth next year, 4% nominal growth next year, and that might be the same or even higher than the US, depending on how fiscal contraction occurs there.
Okay, so that's interesting, Jerry. So you think if you look at the sort of head-to-head battle between the negatives for Europe of tariffs and the positives of fiscal stimulus, you think fiscal stimulus is more significant because of the way it will spill out around the rest of the economy then?
Yes, from a GDP effect as well as a confidence effect, because the tariff impact is reasonably narrow and specific to certain companies. I mean, even a 10 to 15% tariff we think might only shave 5% off European earnings. It's not a particularly big deal in the context of what we think will be an earnings acceleration into 2026 and 2027 on more government spending and greater consumer confidence.
Does that sound like an ECB that continues to cut rates then, if the tariff threat is sort of moderated to a large degree?
It depends how quickly we come up against supply constraints, because at least in things like the manufacturing sector, there's spare capacity. So we shouldn't really be seeing inflationary pressure in certain parts of the market for some time while we absorb that spare capacity. So we'll see. At the moment, there doesn't appear to be significant supply shortages in any factor of production. So we'll be okay for a while.
We see a lot of outperformance in the periphery, or have been, at least prior to the German announcement when it comes to fiscal spend. We've seen that in the bond market. There's a narrative right now that perhaps the equity market in the periphery, the Spain, the Italy, the Greece, will actually benefit because of that inward-looking domestic exposure and less international exposure. Is there merit to that argument?
Yeah, possibly. I mean, countries in Europe are really differentiated more by their sector differentiation than they are their regional differentiation. So in Spain and Italy, for example, you've got larger concentration of financials, which tend to do quite well when you've got a cyclical acceleration, rising growth and inflation expectations. They've also got utilities that we think are cheap and growing. So to some extent, their sector mix has been favourable anyway, but they also are likely to be the economies that doing quite well don't really need lower rates. They're the ones that are already sort of to some extent booming, and so actually it just sort of accelerates their potential growth. So we have no problem with some of these more cyclically and value-oriented markets continuing to outperform the more defensive markets, particularly things like the UK.
That sounds a lot like the bond market and the equity market are beating to two different drum beats. Is that a fair analysis?
Well, not necessarily. So the bond market is selling off, but it's not selling off for sort of the usual European reasons of debt sustainability and concern about, whether governments can afford this, because Germany can afford it, and to some extent it's free fiscal stimulus for the rest of Europe because it won't all be spent in Germany. So bond yields are rising because growth expectations are rising. The real yield is up because this is a more positive growth-oriented acceleration in Europe. Coming through 2026 and 2027. It's the first time we've seen it in a long while. First time Europe has had esprit de corps that really, allows confidence to grow in Europe.
But Jerry, you mentioned the UK. Does the kind of allure of the DAX diminish the appeal of the FTSE? I was talking to someone yesterday ahead of the spring statement from the Chancellor Rachel Reeves saying that it's just government after government announcing managed decline when it comes to the UK economy?
Well, perhaps. I mean, what the UK is trying to do is keep its budget deficit and debt burden in check. But that will be alleviated substantially by growth, which has been pretty anemic. So long as growth can be generated, whether that's through less regulation, whether it's through the stimulus and encouragement of home building activity, which is particularly important for value add. If a dollar spent on home building ends up percolating through the economy more than 4 times, whereas a dollar spent on any service tends to only percolate through the economy twice. So a lot of the activity in the UK should end up producing more growth in time, and with that, there should be more flexibility for the UK government to be a bit less restrained.
Yeah, interesting you talk about free fiscal stimulus for the rest of Europe coming through from Germany, which I get when you talk about where those GDP, where that money gets spent.
Yeah.
And some of it may be on infrastructure companies and defence companies around Europe. But of course, in the short term, it's pushed up yields, and that's an issue for headroom. So I don't know, it's interesting to think of it as a gift. It doesn't feel like a gift, maybe, if you're Rachel Reeves and you're trying to work on your spring statement.
Well, it depends on the growth. So if the stimulus leads to higher growth, then the government can therefore afford the higher yields. So long as it's growth expectations rising with yields, then it should be okay. Because what we're really keeping an eye on is whether those fiscal deficits of countries are above or below the nominal GDP growth in the economy. And if we look at the US, for example, we've now got the largest non-recessionary level of premium of deficit, which is about 7% in the US, to nominal growth, which is about 5%. So the US is growing its debt burden pretty rapidly at this point. That's the case in some countries, like France, not growing very strongly, but does have a 7% deficit. But it's less obvious in other countries that have, lower deficits that actually are roughly in line with or potentially even below the pace at which the economy is likely to grow in the coming years.
There has been a question as well about just record amounts of trillions of cash sitting on the sidelines that hasn't necessarily been deployed to the public markets just yet, or even if they are being deployed, but they're being done through hedging strategies or derivatives, et cetera. You're the perfect guy to ask about this. Are the $6 trillion that have been kind of wrapped up in money market funds being deployed to the public markets?
Well, cash is cash, so someone will always own it, but it is to some extent a reflection that there is perhaps still a lot of COVID-related cash that's floating around the system. So liquidity doesn't seem particularly tight in most markets at the moment, but rather than the $6 trillion of cash, which ultimately is just fungible with somebody else's view on whether they want to hold cash, I'd point to the nearly $17 trillion that foreigners own of the US market. It's a huge amount. It's the highest share of the US market that we've ever seen. We know why, because of US exceptionalism, foreign investors wanting to buy into that story. If that even gets called into question a little bit, let's say foreign investors decide they want 5% less US equities. That's $1 trillion of selling of US equities. It's a huge amount. You try and take $1 trillion out of US equities, it's going to have an impact, but probably only the space of months and quarters, because it's a big liquid market. You try and put $1 trillion into the rest of the world equity market, that's a really big deal. So I think rather than sort of thinking about the cash on the sidelines, I'd think about where investors are invested and whether the news flow that we've seen, both positive in Europe and potentially more uncertain in the US, particularly as they move towards fiscal contraction, might drive a rotation that, even if it marginally reduces US equity ownership, could be a really significant liquidity provision to the rest of the world.
On that trillion then, Jerry, how far through that are we already? Nowhere.
Well, considering it probably only started moving a month ago, I think, you couldn't have moved more than tens or maybe the low hundreds. Very low amount. It's a huge amount of money to try and move. It's an estimate of what could move. It's only a 5% reallocation. But considering how overinvested we know investors have been in the US, it seems entirely plausible. So it does, to me, just say that while there is this uncertainty, the likelihood of slowdown and fiscal contraction in the US, it is a sell the rallies market because of that weakening growth driver and the over-allocation to US assets. And it's a buy the dip market in any other economy that looks like it might be able to generate some growth.
All right, Jerry Fowler, head of European Equity Strategy and Global Derivative Strategy at UBS, joining us around the table this morning. I'm going to do my best Guy Johnson impression and take a look at the core 6. Of course, the heavyweights that move a good chunk of this market. Yesterday, the story was all about tech about 24 hours ago. Today, you're seeing a rebound in some of the other major movers. So, for example, LVMH seems to be driving the market higher, and the French index higher as well, higher by 1.4%. Novo Nordisk also recovering from yesterday. Remember, SAP had overtaken Novo Nordisk in yesterday's session as the largest company in Europe, higher by 0.3% for that stock this morning for Novo, not for SAP. But you are seeing a reversal from the tech space. ASML, I think, is a great example, down about 0.1%. And even Schneider Electric, which was one of the outperformers yesterday, reversing, pairing some of those gains down about 1.4%. So that is your core 6. Got to check some of the other individual stocks on the move with Joe Easton. Joe.
So one stock not having a good day at all, Critty, is Kingfisher here in London. Now remember, this is the B&Q owner, the retail DIY company, and it is dropping at the most since November today. So we're down almost 12% for Kingfisher now. Actually, most of the weakness seems to be in France. The French market is where the weakness is. The UK actually holding up pretty strong in terms of all of us doing our DIY. The like-for-like sales look pretty stable in the UK, but it's France where we are seeing a lot of weakness, and that is the reason we're seeing the drop in that stock today. Then I'm also looking at truck makers. Barclays out with a note today, downgrading all three of the big truck makers. So they downgrade their ratings on Volvo, Daimler Truck and Traton, and this is linked to not only US tariffs, but also a few weeks ago we saw news that the US is rolling back some of the regulations on the emissions of trucks, and those emission regulations were seen as a reason for companies to buy new vehicles, and now that won't happen according to Barclays. They don't think that this big order increase will come through, and therefore they're downgrading those. So actually, as you guys were mentioning on the show earlier, most of the auto sector holding up pretty steady today, but the truck makers really weak following that news, that note from Barclays today. Then in terms of energy, Shell looking pretty strong, increasing their returns, potentially around half of their spare cash could go back to shareholders, and continuing their margins and margin progressions looking pretty strong as well. The one negative on that report, on that CMD update, according to UBS, was there was no new quarterly dividend increase, according to UBS, and that was a negative. But for the moment, it's holding up pretty steady and continuing the outperformance that we've seen against its big rival BP here in London. And then finally, the other energy stock going the other way was Neste over in Helsinki. This is a downgrade this morning at UBS. This is a company they say is actually seeing weaker than expected margins. So they cut their rating. They were buyers. They move it down to neutral, and actually that's been one of the worst performing energy stocks in the past year, partly because of their renewables business that is struggling. Neste weak today. Shell doing pretty well in the energy sector in terms of the movers this morning.
Yeah, absolutely. Shell doing okay. Joe, thank you very much. Joe Eason from our equities team. Now, because we are, Critty, a little closer to the United States this week and the past 2 weeks, we have US pre-market open, don't we? What caught your eye?
Yeah, the most wonderful time of the year, I think, when it comes to the U.S. pre-market. Let's talk about Tesla here, because, of course, we did have those drops in European sales numbers, specifically in Tesla numbers as well, and yet the stock is higher. And I think it's worth noting that the shares are higher by about 0.5%, 0.5%, $279 a share. But this is a stock that has been beaten down quite a bit, so there is an element of buy the dip here, especially when it comes to the auto sector. And you're seeing that sentiment also echoed in a lot of the European automakers as well. That's going to be one name to watch, including how it's moving with some of the other tech names. The other one I've got my eye on is Boeing shares. Shares are down about 0.4% in the pre-market. Now, it's worth noting that the Wall Street Journal has reported that they are seeking to withdraw the guilty plea deal in the 737 MAX case. Now, this is a really big deal because it does actually intervene and have an effect on how quickly Boeing can recoup the losses and actually come back to the production story. The guilty plea was part of that agreement with the DOJ. It looks like they are now reported to be, by the Wall Street Journal, I should say, looking for more lenient treatment. The shares not responding well to that. And I'm going to say Oracle also wrapped up in some legal battles here, this time around Paramount's sale to Skydance for about $8 billion. Now, remember, the CEO of Skydance is David Ellison, the son of Larry Ellison, who is the founder and CEO of Oracle as well. Those shares down about 0.5%. The legal battles in both Boeing and Oracle very much having an effect on the markets this morning.
Coming up on the program then, Critty was just talking there about what's happening with the Tesla share price. We've been tracking global autos. European autos were a little stronger this morning out of the gates, fading those gains a little. The global auto industry bracing, of course, for US tariffs after Donald Trump says he will proceed with levies on vehicle imports in coming days. So it sounds as if that could come before April 2nd. We'll discuss that next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Welcome back to the opening trade. Now, the Airbus CEO, Guillaume Faury, says any potential tariffs between the US and Europe could be more problematic for the plane maker's rival, Boeing. Airbus's main factories are globally more spread out than Boeing's, he says, which only assembles its aircraft in the United States. In an exclusive interview with Guy Johnson, Faury added that he's encouraged there hasn't yet been talk of aviation-related tariffs.
We had tariffs on aircraft 4 to 5 years ago between the US and Europe, and has been a lose-lose. Therefore, we had a ceasefire in 2021, and I think this experience has been interesting in showing that for a sort of North Atlantic ecosystem, both sides of the Atlantic, there's only lose-lose in putting tariffs. We have not heard about tariffs on aviation at the moment, on aerospace. I think that's a good sign. There's nothing more, I would say, really to prepare than to communicate, to exchange, to explain. We have a lot of infrastructure and manufacturing capabilities, final assembly line in the US. We are procuring from the US, we are selling to the US, and the US manufacturers are doing the same with Europe. So tariffs in the middle of the Atlantic would really be a big burden for both sides, and maybe that would be even tougher for the US manufacturers.
Have you been putting extra resources into the Alabama plant? Have you been stockpiling? Have you been? There's no kind of preparations or anything that you have been taking on thus far in order to get ready for something that could be coming?
No, we keep doing what we've been doing so far, relying on Alabama. Indeed, that's a plant where we have 3 final assembly lines. One is not yet delivering planes, but the 2 others are. So we are procuring from everywhere around the world, assembling there in the US with US jobs. 2 US airlines as well. So I think we are key to the US ecosystem, to the aviation ecosystem, and we think that plays a big role in how tariffs are targeted.
Okay, final quick question. You sit on actually the Business Council in America. You speak to CEOs there. What message did you take to them from Europe? What is the message that should be coming to A, US business, and B, the US administration?
Well, at the moment, I think there's a lot of questioning of where all this is going, what it will mean for which industry. It's a bit on wait-and-see mode to understand better for how long tariffs could come, who will be impacted, how to respond to the tariffs, if any. As I told you, we are not directly targeted with tariffs at the moment, but indeed there is a lot of questioning and to understand better what is changing and how to adapt.
The Airbus CEO Guillaume Faury speaking exclusively to Guy Johnson. That's the aviation sector sorted. Let's pivot to auto, shall we, Chrissy?
Let's do it. Donald Trump says he will proceed with long-threatened tariffs on auto imports in the coming days. The U.S. president also indicating that some nations may receive breaks from next week's, quote, reciprocal levies. Joining us now is Bloomberg's Craig Trudell, who leads our global autos coverage and has the fun job of tracking everything Donald Trump says on that front. So what do we know, and how happy are Americans about this?
I think the short answer is we don't know what we know at this point. There are a lot of sort of unknown unknowns because one day Trump is sort of leaning that these are coming. The next day there's sort of indications, sort of smoke signals coming from the White House that maybe sector tariffs will be avoided. I will say that I'm not necessarily shocked to see that Trump would sort of keep leaning back toward doing this, in the sense that when he talks about trade and when he talks about tariffs being, the most beautiful word, it's almost, like clockwork. He turns to cars almost right away consistently. This is something that, is sort of stuck in his mind as the way in which the U.S. has been, in his mind, treated poorly, treated unfairly, and he wants to level that playing field and deliver manufacturing jobs.
Craig, I'll admit I was a little surprised to see the car makers doing so well this morning. The likes of BMW up more than 1.3% this morning. Is that schadenfreude about the Tesla numbers? Just disappointing sales here in Europe. A 40% drop, I think it was, for February. Or is it to do with tariffs? What is this?
It's hard to say. I mean, I do think that it is sort of abysmal, the numbers from Tesla to start the year. The ease with which the rest of the industry is having selling electric vehicles. It's not just that Tesla was down 40%. It's that the rest of the industry, even despite that big player being down so much, was up more than 30%. I think the overall sales for the industry were a little bit soft, but I do think that when you look at sort of how this market is changing a bit, it's becoming much more competitive, and it's no longer the case that Tesla's up here and everyone else is way back behind.
And talking about big sellers of electric vehicles takes us to BYD. They had some numbers out. This is the biggest seller then in the world's biggest market. So this is certainly one that we need to keep on our radar, but still not a huge presence in Europe and definitely not the United States.
No, that's absolutely the case. I think the way that BYD has evolved just the last few years, it really is sort of breathtaking how quickly they've grown. For them to actually have more revenue last year than Tesla did, to do that not just with fully electric vehicles, but with plug-in hybrids as fully electric vehicle growth slows.
Okay, Bloomberg's Craig Trudell across the bajillion car stories out this morning. We thank you. And coming up on the programme, Ukraine's energy infrastructure hangs in the balance after the US-Russia talks. We're going to talk to the UN's nuclear watchdog chief next. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
This is the opening trader at 30 minutes into today's session. Seeing green on the screen across the board. Euro stocks 600, I think I should say, higher by 0.3%. But the DAX is now unchanged. A real reversal in terms of outperformance that we saw over in Germany. Now replaced perhaps by the French index. LVMH is a big part of that story. CAC 40 higher by 0.4%, Anna.
Let's pivot, Kriti, to some of the geopolitical conversations that are taking place globally. US and Russian officials have concluded talks in Saudi Arabia, with a statement expected shortly. It follows an equivalent meeting between the US and Ukraine on Sunday, which placed renewed focus on the country's energy infrastructure. The Trump administration's push to contain the war in Ukraine runs parallel to a ratcheting up of pressure on Iran to strike a new nuclear deal. Lots to discuss then with Rafael Grossi, the Director General at the International Atomic Energy Agency, the IAEA. And it is a pleasure, Rafael, to have you on the program. Thank you very much for joining us. So your organization to promote safe, secure, peaceful use of nuclear energy. With that brief in mind, Rafael, what is at stake when you watch these conversations about Ukraine between the US and Russia?
Well, pleasure to see you again. Let me say that of course, my first reaction would be one of relief, because we see that for the first time, there is a possibility that with combat ceasing, stopping the dangers that have been hanging over the biggest nuclear power plant in Europe and one of the biggest in the world would recede. I can tell you that in September 2022, I personally led a mission by the IAEA, and we set up a presence there, a permanent presence at the plant. And over the past 2 years and a half, 2 years and 7 months, more precisely, we have been witnessing many dramatic moments, some shelling, drones, blackouts, several, more recently a cooling tower of the plant up in flames. So a number of occasions where we were very, very close to a nuclear accident with serious radiological consequences. So for the first time now, we see that there is a discussion, at least, about the possibility of this sort of ceasefire, which could bring some relief and a possibility, hopefully, as everybody else is waiting for something bigger, wider in scope. So we are following that and perhaps ready to play our role in this.
Okay, and yes, as you point out, you have had, the IAEA has had a team on the ground working in very challenging conditions at Zaporizhzhia, at that nuclear facility, Rafael. How lacking is the maintenance there? How far from able are you to assure the international community that everything is exactly as it should be at Zaporizhzhia?
I would make a distinction there, Anna. One thing is the danger, which is, of course, concomitant with having such a big nuclear power plant, 6 reactors, lots of nuclear material inside, in a combat zone, with the distinct possibility that you could have a direct hit or something of the sort. And then you are mentioning the issue of maintenance. Maintenance, we have to bear in mind that the plant is under Russian control. As we know, this is, of course, a disputed fact, and, of course, Ukraine is contesting this, but the reality is that this plant is under Russian control. The IAEA is there. There is no imminent danger in terms of the maintenance, internal maintenance of the plant. So the preoccupying factor, the concerning factor, is the fact that this is in the middle of a war zone. And the other thing that I think, and I hope, once there is some understanding, some agreement at the political table, is how to do the necessary checks that are obviously necessary. Don't forget, ladies, that this facility, which is a huge one, has been in what we call in the jargon shut down, in cold shutdown we call it. So before you restart such a huge facility that has been operating at a very, very low level, there are many things. Imagine a car or something, any sort of machine that you haven't been using for a long time, winter, summer, etc. So you have to do a lot of evaluations and assessments to be sure that there is not going to be a problem. So that is part, I think, of the next steps. But when you ask me, Anna, about the imminent thing, I would say is more the fact that we are continuing in a place where people are shooting at each other.
Yeah. Raphael, Lizzie here. Good morning, and thank you for joining us. Let me ask you about this proposal from the French President Emmanuel Macron. He's been pushing for France's nuclear weapons to be used as a regional deterrent. I wonder, would a nuclear umbrella actually work?
Well, I must say that here, again, we have to make a number of distinctions. Because what has been said by President Macron and others does not apply directly to the resolution of this conflict. They are more, talking about the new security, if you want, strategic configuration and how to guarantee it. Another point to be reminded of is that under the current agreements that Europe and the Atlantic Alliance do have, nuclear weapons are deployed in Europe. Even American weapons are deployed in Europe. So we are not seeing something completely new. What we are seeing is a reconfiguration of this, and perhaps it's not my thing to be talking about what at the political level President Macron or others may be deciding. This is a political thing, but I'm just telling you from a technical point of view that the presence of nuclear weapons there, and also be reminded of from the Russian Federation, nuclear weapons deployed in Belarus. So it's been part of that. In general terms, of course.
But I understand, Raphael, that this is. I understand it's strategic, but of course we have to be asking the question about, for example, how exposed the UK would be if relations with the US broke down, if cooperation on nuclear weapons broke down. We've just been reporting about this leak, the top US officials privately discussing how Europe is pathetic. Is this a safe alliance to rely on?
Well, that is part of the political conversation, of course, and the political dialogue, which is not something the IAEA is following as part of its mission. What I would say is that we need, of course, circumspection when it comes to talk about nuclear weapons. Circumspection and restraint is what is needed. at this moment. We are seeing the possibility after almost 3 years of a bloody war in Europe, the possibility of a ceasefire, the possibility of some stability being brought to the table. So quite clearly, from the perspective of an international organization dealing with non-proliferation and nuclear weapons, what we are calling is, of course, we're not telling, I should not be telling Prime Minister Starmer or President Macron or whomever what to do. What we are saying is circumspection, restraint, and of course, nuclear weapons, we should never forget, are the ultimate instrument of destruction. So there should be very long and deep thought about that.
Well, Rafael, speaking of that long and deep thought, let's talk about another part of the world, and that is Iran, of course. We know we're seeing some very hawkish rhetoric out of the Trump administration. Excuse me. The Trump administration has favored a complete stop to Iranian enrichment. How realistic is that possibility?
Well, on Iran, again, I would say we are in a new chapter, not for the IEA. We have been dealing with Iran for the last 20 years or more. But we are at a very, I would say, important juncture in the sense that we know that there has been an outreach from President Trump, a letter being sent to the spiritual leader of Iran. I have been in Tehran last November, talking to President Pezeshkian, talking to the foreign minister, and I might be returning soon. I think it is clear that we need to have some form of understanding. Of course, with Iran, an understanding that would preclude completely the possibility of Iran getting a nuclear weapon. Because in the current, obviously, in the current circumstances, against the backdrop of a Middle East that is at a very volatile phase, the addition of to the pot of nuclear weapons would be catastrophic. So I think we are all clear on the need to avoid this situation. How you get it, how you get to that point, this is the key. And there was an agreement, as you know, the famous JCPOA, which had been signed in 2015 with great pomp and circumstance, that does not exist anymore. You don't have that anymore. It exists only by name. So there is
Rafael, let me
measure of control.
Let me
at the moment.
Understood. Let me talk to you about your role and the IAEA's role in that. There's been a probe specifically for Iran looking into uranium particles detected at undeclared locations. So in terms of active measures of that monitoring, walk us through if you're any closer to resolving that probe and what you've learned from your discussions in that area.
Well, we are not, I must admit, we are not where we would like to be. We, as you rightly said, we detected, discovered traces of uranium at places that were not supposed to be or to having hosted any nuclear activity. So we have been asking our Iranian counterparts, where is this material? Where is the equipment that was evidently used to deal with this material? So we haven't had, I must say, answers or satisfying answers, rather, to these questions. The process continues. As I told you, I was in Iran. I intend to continue. But now these things come together. They gel. Because you have, on the one hand, these unresolved questions from the past, and then at the same time, the possibility of having some viable agreement for the future. But as you know, common sense dictates, you cannot build on shaky basis. You need to have the truth first to see where you go and you move forward. And we are going to be working with that, with the United States, with Iran, with our European friends. We must do it. It's absolutely necessary.
Well, Rafael, we look forward to that update on that probe. A final question to you on maybe how the IAEA is approaching not necessarily the geopolitical hotspots of the world, but specifically the build-out of nuclear power in Europe. There's a lot of conversation right now among the major tech players in the world that for an AI data grid build-out, nuclear power is an answer to the prayers of the energy crisis, sustainability. What evidence are you seeing of that as nuclear as an answer to that AI build-out?
you know, we are not peddlers or lobbyists for nuclear energy. We promote the peaceful uses of nuclear energy, and quite clearly, nuclear energy is indispensable as part of the right answer to the current energy and economic situation. I like to say that what we are seeing is a return to realism when it comes to nuclear. Nuclear has a role to play, has been playing an important role. In G7 economies is indispensable, is very big. And now, interestingly, and I think you have mentioned this, of course, from the perspective of Bloomberg, I find it absolutely logical. We see in the economy, we see sectors like AI, IT, that require lots of energy, CO2-free energy, dispatchable energy, which is there 24/7. In a very, I would say, modular way. And of course, people have been looking at alternatives, and small modular reactors and nuclear reactors are part of that. And we have seen Google, Meta, and many other companies signing contracts with nuclear providers in order to have these small modular reactors. So we see the evidence there. For rollout, if you ask me, perhaps it will be within the next 5 or 6 years, but quite clearly the trend is there.
All right, Rafael Grossi, Director General of the International Atomic Energy Agency, covering a range of topics for us this morning. We thank you so much for your time. Coming up on the program, HSBC planning to double down on investment banking operations in Asia and the Middle East. More from our exclusive interview with the CEO next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. Now, the HSBC CEO plans to double down on investment banking operations in Asia and the Middle East after exiting key businesses in Europe and the US. The CEO, George El-Hedry, spoke exclusively to Bloomberg's David Ingles at the bank's Global Investment Summit in Hong Kong about that shift.
So what we announced is we will be incurring about $1.8 billion of cost, essentially severance cost.
Okay.
That the saving, most of the decisioning for that will take place this year. Most of it will take place in the first half of the year. That the benefits will start materializing this year, where the $300 million benefit will come this year. That the benefits will materialize in full by the end of full year 2026. So the full year 2027 will benefit from the full $1.5 billion saves that we're targeting. What we also committed that these will be permanent saves going forward, and that we're taking these saves straight to the bottom line.
Okay.
So it's a payback period of effectively roughly 2 years, but it's a permanent benefit that we will achieve.
And then the other component there is a further $1.5 billion, which I was looking at your earnings statement, and it was page 11 or 12, I think, of the strategic review. And the way you phrase it there is a reallocation of those costs into growth businesses. So I think it's a two-part question I have is, if you're reallocating costs, is that a net savings? Is $1.5 billion net savings? And what exactly are you looking at doing? Because there's not a lot of detail on that.
Yeah. So the organizational simplification benefits, which are efficiency saves, not impacting revenue in any material shape, $1.5 billion, those will be taken to the bottom line. That's the first $1.5 billion.
Yes.
Now, additionally to that, we're also looking at what we do and recognize that there are further focus that we can achieve in our business, where we will be taking $1.5 billion from activities that we are currently doing that are either non-strategic or non-returning, and we will reallocate them. We'll reallocate these $1.5 billion as we materialize the saves. We'll reallocate them back into areas where we have competitive strength, where our customers expect us and need us to be, where we can generate good returns, and where we have greatest opportunities to grow. This second $1.5 billion, the revenue we will lose against it because we will be stopping activities.
Those units, those assets, yeah.
Those assets. We expect to be able to generate better quality revenue instead, because they're more strategic or higher returning.
And have you told your team, have you given a timeline for that second tranche of?
Yeah, we expect to do it in the medium term, but there are a number of these initiatives which we already communicated to the market. For instance, about $300 million of this $1.5 billion will be delivered through our decisions around investment banking, in particular M&A and ECM in Europe and in Americas, where we're basically scaling down this activity. And others will come from other inorganic activities, such as the sale of our German private bank business, the sale of our French insurance business, Bahrain retail business, etc.
The HSBC CEO, George El-Hedry, there speaking exclusively to Bloomberg's David Ingles. Let's get analysis now of that HSBC restructuring update and its business outlook with Bloomberg's Jenny Serene. Jenny, El-Hedry seeming pretty pleased with himself by the sounds of things on that restructuring, but what's left on the horizon in terms of the cost cuts?
Yeah. So I think it was super interesting to kind of hear him lay it out, because they've basically identified about $3 billion worth of costs that they can get rid of in this business. Now, $1.5 billion of that is just costs that will go away. They'll allow that to drop to the bottom line. Shareholders should be pretty happy about that. The other $1.5 billion is areas that they're going to reinvest in. So he gave the example of investment banking. So that's where, they've decided we're going to get out of things like doing IPOs or advising on M&A in places like Europe and the US, where we've just never been able
able to really make a mark. And we're going to reinvest that in areas like Asia and the Middle East, where we think we have real opportunity to grow and a franchise that can actually get scale. So I think you see him kind of trying to hit both marks, both pleasing shareholders, letting some of that drop to the bottom line, while also trying to have an eye on the future and making sure that they're kind of growing into that. But it'll be interesting to see if he can pull it off, because it's certainly a tightrope that he's got himself on.
Walk us through then kind of the growth that's meant to be coming from Asia and the Middle East specifically. Why dive in when they so actively dove out?
Yeah, no, I think it's a really interesting question, because, you see them pulling back on places like Europe and the Americas at a time where we expect deal volumes in those two places to really surge. And so you see them kind of shifting their focus to places like Asia and the Middle East, which, to be fair, are fast growing. But it'll be interesting to see if this is a good bet in the end. Are they pulling out at the exact wrong time, or are they calling it quits on a business where they've just never been able to make traction? I think that's the kind of key question that investors are going to be putting to the CEO, especially in these next months ahead.
And Jenny, let's talk jobs. And have we seen the people who, because these are big changes, so have we seen the people in the regions where they're pulling back that need to leave the business? Have we seen that happen already, or is that still to come?
I think that's still to come. So when he talked just now about the $300 million that they see kind of hitting the bottom line this year, that was specifically around a lot of the investment banking moves that they're making. So what they've said is, we're going to keep doing the deals and the IPOs that we've already agreed to do, but we're not going to sign any new ones. And so as these deals slowly make their way to completion, the employees that are working on those projects will be going away. And so he talked about that in the interview too. It was super interesting to kind of hear him talk about the human side of these changes. And so it's kind of an important reminder that these CEOs, they make all these big strategic decisions, and then, as they have to carry them out, it's tough work. So absolutely, I think that'll be another kind of big shoe to drop with all these changes, is actually exiting some of these employees.
Jenny, thank you very much. Jenny Serrain there, Bloomberg's Europe and Middle East finance editor. Now, in the next hour, the IFO Institute president, Clemens Foist, will be joining the Pulse to discuss the latest IFO survey results, including the German Business Climate Indicator. And this could be fascinating. Valerie Teitel joins us with a preview of that. The German data then out. And Valerie, we've already heard from investors, and their expectations have been reset by German fiscal plans. What are we expecting from this IFO number, the reading on German business?
Anna, we'll be reading through this data print in just a few minutes' time. If it confirms the positivity that we got out of the PMIs yesterday, which showed business activity at the highest levels in 7 months, a lot of that across Europe, driven by a continued rebound in manufacturing in Germany. Will the IFO data later confirm this recent positivity? Because, yes, there are positives and negatives weighing over the German economy. The negative being the tariff threat from the Trump administration. The positive being that potential spending boost, the infrastructure spending, helping drive manufacturing and maybe driving more private investment back into the German economy. We'll be watching to see if that IFO print today confirms the more hopeful ZEW and PMIs yesterday.
All right, Bloomberg's Valerie Teitel. We look forward to that data, and of course, you breaking it down for us. We thank you so much. In the meantime, we are also going to be talking about Shell. You did have some lines coming out early this morning. They are changing some of their buyouts. It is one of your best performers this morning, actually moving not only the FTSE 100, but moving the Stock 600 as well in terms of upside index contributors. We are lucky to be having a conversation with the CEO, who will be speaking to Bloomberg later today. That coming up on the Bloomberg Close at about 7 p.m. London time, 3 p.m. if you are in New York. And that, of course, are some shares that are moving pretty significantly this morning.
Yeah, the stock up this morning. And European equity markets broadly are up then, up by 0.5% on the Stock 600. We are looking for the latest tariff news headlines, as we are on a daily basis, it seems. US futures point a little bit lower than Lizzie, down 0.2% on E-minis.
Yeah, and not much difference between the FTSE and the Stock 600. I'm going to grab a water.
Yeah, that's a good idea.
The Pulse is up next. That does it for the opening trade. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
More trade uncertainty as President Trump says auto levies will be announced over the coming days. Now, he also appears to invent a new economic threat, warning of secondary tariffs. Tesla's dismal run in Europe continues with a 40% drop in sales in February. Car makers on the continent also see a broad drop. Plus, HSBC targets growth in Asia and the Middle East after exiting key businesses in Europe and the U.S. We'll have more of our exclusive interview with the Chief Executive, George El-Hadary. Now, first thing is first, let's go to U.S. futures. We've had quite a lot of volatility over the last couple of days. Look, tariffs have definitely been dominating the news flow of this week. U.S. stocks soaring yesterday on signs that trade sanctions will be a little bit more narrow than feared, but now secondary tariffs are a big question mark when it comes to investment. S&P futures down some 0.2%. European stocks, though, seeing a slight lift up. Now, there are a couple of components to that. Now, European stocks are gaining thanks to Shell really lifting the benchmark indices, oil advancing again as President Donald Trump has been threatening to punish any nation purchasing crude from Venezuela with a 25% tariff. We also look at tech and then Bitcoin 86,696. You can see the dollar index 1,272. Now, the other thing we need to watch out for is, of course, the trajectory for Germany going forward. IFO numbers just breaking the Bloomberg terminal. That Germany March IFO business confidence coming in at 86.7, bang in line with expectations. Now, shortly, we'll be speaking to the IFO Institute president, Clemens Fuest, in just a moment. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump says some countries will receive breaks from reciprocal tariffs. The comments have sowed more confusion about his plans, which are due to be announced on April 2nd. Now, we'll discuss all of that in a moment with Jari Sten. He's Chief European Economist at Goldman Sachs. But first, let's bring in Bloomberg CIBA News Director Ross Matheson to talk about the reported Washington messaging breach. Now, The Atlantic's top editor says he was added to a text group where U.S. Defense Secretary Pete Hegseth shared share detailed plans for bombing Houthi militants. Well, Jeffrey Goldberg says he received a connection request via the encrypted messaging service Signal from the National Security Advisor, Michael Waltz. Now, a White House spokesperson says the report appears to be authentic and they're reviewing how the journalist was added to the conversation. And Roz, this is really what anyone's talking about apart from tariffs. I mean, if this report is true, and it seems that even the White House says, look, this probably happened, it really raises some serious questions.
Well, that's right. The White House is basically acknowledging this happened, but playing down, obviously, the ramifications from it and how, in fact, a journalist could be added to a Signal group for a matter of days and no one seemingly noticed, as they discussed, it appears, quite sensitive information, including classified operative information about planned operations against the Houthis in Yemen, but also, you know, just quite a window again into the operation of the Trump administration, the use of emojis, you know, the debate that went on, the comments about Europe, which at this point shouldn't be a surprise, but showed again the level of the commentary about the relationship with Europe, the disdain for Europe in a way that it seems to come across in these comments, and talking about Europe essentially freeloading and at some point potentially presenting a bill to Europe for helping to patrol the Red Sea and for these airstrikes on the Houthis. But it raises those questions again about the security of information, about the way that stuff's shared. I mean, Signal for a start, which, you know, messages disappear, so you have no record of that. Where were some of these officials potentially when this was happening? Was Witkoff, in fact, in Russia when this was going on? And, you know, again, about what can allies in Europe do from here when it comes to intelligence sharing?
And that's $1 million question. So it goes to intelligence sharing, but also if you're an ally right now, you'd be second guessing what you can do next. I mean, it's the final nail in the coffin of really understanding what the U.S. wants with Europe.
Well, it's about that edict at a company, right? You never write certain memos unless you presume that that memo might become public at some point. So in a lot of your communications, whether it's, you know, phone conversations you would normally think would be private or other interactions, you have to presume that there's a chance that some of that becomes public at some point. But the reality is, even with all of this, that European nations, and those are in what's known as the Five Eyes alliance, including the UK and Australia, they're unlikely to completely pull back from intelligence sharing because they can't, because they get a lot of stuff in turn from the US. So it's very difficult for them to stop intelligence sharing entirely because they're reliant on the US for it. And so unpicking all of that becomes very complicated. But certainly for politicians, you know, heads of state in all their conversations or their cables or their memos, you can imagine them being very, very cautious about what might come from what they would think to be private conversations.
And Yari, I mean, in the context of tariffs, there's just a lot, and this is definitely dominating the news cycle. It's not actionable if you're a market investor, but how do you put that next to tariffs? Is it, you know, is there chaos, or is there a clear laid out plan, longer term, that the markets needs to understand and what the Trump administration wants to do?
Yeah, I think it's very uncertain at this stage where exactly trade policy is headed. I mean, what has been signaled in the run-up to April 2nd is that every country will be given a tariff number that consists of an existing tariff differential, non-tariff measures, and then potentially some adjustment also for tax differences. But that gives you a pretty wide range in terms of where these initial tariff numbers might come out. Most likely is probably that the numbers initially will be relatively high, then there will be some negotiations, and then ultimately you probably end up with somewhat smaller numbers. That's been the pattern so far. But the uncertainty that's being created by this is obviously important in of itself when we look at confidence, when we look at investment plans and so on.
Okay, thank you both. Bloomberg's Ross Matheson and Yari Sten from Goldman stay with us. Let's also dive into the latest IFO Institute survey. Let's get straight to Clemens Fuest, president of the IFO Institute. Mr. Fuest, we just had that IFO number pretty much in line with expectations. Look, the German parliament has agreed to this big spending package, and this could be a game changer for Germany, but also these hundreds of billions of euros in infrastructure and defense spend could be a game changer for Europe. Do you think this is what will get Germany unstuck?
Well, I think a lot of work remains to be done, but it's maybe a first step. the IFO reading today maybe also reflects the mere fact that we do have a chance to get a stable government. There's a lot of fragmentation, political fragmentation in Germany as well as in other countries, and there was some relief when the results of the elections were such that yes, there is a chance to have a stable government, a coalition of the Social Democrats with the Conservatives. Now, this spending plan is a big change. It will have to be complemented with other types of reform. If not, it will maybe have primarily affect inflation. The question is, for instance, if we look at the construction industry, building infrastructure, it is running at full capacity at the moment. So there are concerns that the more money thrown at them will raise prices. We need reforms that encourage companies to build up capacity. We need a simplification of planning permissions. And it is only with these complementary reforms that we will get an effect on infrastructure spending. So there's more work to be done, but the spending package is certainly a first step.
So are you hearing the right signals actually from the government that these extra measures will take place with the money to make sure that it gives, again, the economy the biggest possible impact?
Well, I guess that's the issue at the moment. So what comes out of the coalition negotiations is that there is a lot of disagreement on fiscal policy, on deregulation, and it's not clear how this will play out. The first result is that the coalition negotiations will take longer than anticipated. And I would expect that in the end, the parties will agree on something, but it will probably not be a very ambitious reform package. And that's the challenge. At least maybe in the field of planning permissions, this is not so controversial. Maybe there will be some movement there, but this whole package will remain a challenge.
Yeah, a challenge, but overall, I guess, a positive. At the same time, what are companies saying about these new tariffs coming into place? How do they? Is it a net positive, a net minus that kind of cancels each other out? If you look at the defense spending, the infrastructure spending, but then this fragmentation of trade.
It's interesting that we see little movement in our survey in the sectors where you would expect movement, maybe. If you look at the construction industry, especially the part of construction industry out of residential buildings, so building infrastructure, there isn't very much movement here in the survey, so companies seem to remain skeptical there. At the same time, there is no collapse of export expectations, so the fear of new tariffs doesn't seem to be very large, or maybe it hasn't changed very much. And I guess that's related to the fact that Trump has been very volatile, announcing tariffs, then taking them back. I mean, there is a basic concern about U.S. trade policy, of course, but we haven't seen major changes in these concerns, at least in this survey during the last month. That may change when the Trump administration actually publishes its plans announced for next week, but currently we don't see much in the survey.
Okay, Mr. Fust, thank you so much. The IFO Institute President there, Clemens Fust, still with us, Ross Matheson and Jari Sten. Jari, I mean, we're talking a little bit about the tariffs, and, you know, I'll ask Ross in a second. There's so much confusion about these tariffs. We don't exactly know. I don't exactly know what's coming on April 2nd. But what does it mean for the European economy? It makes it more complicated for the ECB. It makes it more complicated for also a lot of the measures that governments are putting in place.
Yeah, for sure. I would say the framework we've been using is to distinguish really between targeted tariffs and broad-based tariffs. So I think as long as the tariffs remain more targeted, so focused on individual sectors, then we think overall from a macro perspective it's a significant negative, but it's manageable. But of course, once these tariffs become targeted across the board, or if, for example, the VAT adjustment will be part of the tariff announcement, then of course it becomes a much more broad-based challenge. So the numbers that we have are roughly a 0.5 point hit to GDP if it's targeted tariffs, which is our base case, and then 1 or even 1.5% of a hit to GDP when they become more broad-based. So you can see that the numbers are both negative, but the broad-based tariffs are really the ones to worry about. Now, when you get to the ECB, there's of course also a price effect that if you have tariffs and you retaliate against them, you push up inflation. But I think quite importantly, it's a pretty mechanical effect. It's a one-off effect on prices. And so when you look at weaker growth and only a one-time effect on inflation, we ultimately think it's not something the ECB should really worry about. And that's why we think they will cut in April, despite a pretty non-committal messaging out of the ECB.
And Ross, I guess the biggest concern is, we kind of know what's coming April 2nd, but then it could change very quickly. Right. So do you have any insight into the Trump administration thinking? It's almost like they're muddying the waters because it gives them power to negotiate better.
Well, that's right, because he does like to keep things in the back pocket because, above all, he's a businessman and he likes to keep people, companies, other leaders on their toes, and he likes to negotiate. We see he seems to have invented a new thing overnight, which is secondary tariffs, which is probably his version of secondary sanctions, but he doesn't really like sanctions, so he's going to call them tariffs. But that shows, again, how he's using all of this really as a political tool and a negotiating tool. So he'll penalise countries that import oil from Venezuela as a secondary tariff. So again, what he likes to do is keep the chessboard moving all the time, and that's why we will still see, even after April 2nd, probably a lot of uncertainty, because he's flagging now sectoral tariffs on autos maybe before April 2nd, maybe after, but still chips, the pharmaceutical sector, those are all things he says are still to come, and he's going to use tariffs very much as a weapon for politics against individual countries or groups of countries. And so this is just the environment we're in, and it means that for companies and for economies, they've got to adapt to that.
Ross, the other question, and I imagine that one of his big pillars is trying to get cheaper energy, including cheaper oil, is actually what's happening in these Russia-US talks on Ukraine. Are we closer to something?
Well, they had very, very long talks yesterday. We understand that the US officials are back talking with Ukrainian officials again this morning, so they seem to be pushing towards something. We know these conversations were very technical. Yesterday focused very much on the Black Sea and maritime traffic, so probably some arrangements around that, to your point about making sure that everything can leave Ukraine, including grain potentially also, which is important for a lot of regions around the world. And so can you get certainty around trade and maritime traffic, whether it's going to extend to something broader than that, or it's a bit of a sort of Lego ceasefire where you're stacking ceasefires on top of each other again, and you get the energy arrangement, then you get the Black Sea, then you get something in terms of the situation on the ground inside Ukraine with territory. So it's a bit by bit move, but we are expecting some kind of statement from the US and Russia collectively at some point today, and it seems they are gearing up to announce something, but it's probably more around the Black Sea.
And Jari, how should we look at the energy complex for Europe? Again, if you look at inflation pressures and the fact that we still don't know whether tariffs hurt growth more than they bring up inflation, how should we look at the price of oil?
Yeah, this is one area where over the last few weeks there's of course been some relief for Europe. Oil a little bit, but mainly gas. Yeah. So when you look, for example, at the cutoff point for the ECB staff projections in March and what has happened since then, a weighted average of oil and gas is down almost 15%. So I think it does help in terms of the inflation outlook. We, of course, have also seen some appreciation of the euro recently that, again, helps you with the inflation outlook. And so we do think that despite all this uncertainty around trade, that we are on track in terms of the inflation picture to converge to 2%. And I think the ECB can take comfort from that despite all these uncertainties that we're talking about.
Okay, thank you both. Our Bloomberg EMEA News Director, Ross Matheson, and Jari Sten stays with us. We'll also talk, of course, about the spring statement. Coming up, Donald Trump says he'll announce tariffs on autos in the coming days. We'll examine the potential impact on Europe's car industry. That's next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back, everyone. European auto stocks higher this morning, brushing off President Trump, saying he'll announce tariffs on autos in the coming days. Well, still with us, Yari Sten, Goldman Sachs' chief European economist, and we're joined by Craig Trudell, who leads Bloomberg's global autos coverage. So thank you both for either sticking around or joining us. Craig, cars, I mean, are they going to be really in the firing line of the Trump administration?
I think, you know, if we go off of what he's been saying consistently, not just for years, but for decades, it's been that, you know, when he talks about trade and when he talks about the way the U.S. is treated even by, you know, countries that we would consider U.S. allies, you know, that he strongly views cars as being a sort of front and center example of the ways in which there are inequities and how U.S. cars are treated relative to other countries. Now, is there nuance to that? Is there reasons that U.S. cars aren't desired elsewhere in the world?
I was going to ask you.
Important question.
I mean, it's true. I mean, there are not that many Fords, right?
Correct.
I mean, maybe there are a couple of Ford Mustangs, which is a good-looking car, but there's just not that many, you know, cars driving through European cities. Is it the size or is it regulation?
I think size, regulation. I think importantly, a lot of the Fords that you do see here in Europe are made here in Europe. So what you know, what need is there for Ford to import into European countries? And you have, you know, GM, the biggest U.S. car maker, essentially absent from Europe, right? They pulled out years ago when they sold Opel and Vauxhall. So you have these sort of structural, you know, issues where, you know, there's not really a sort of way in which Europe can sort of answer his criticisms by saying, sure, we'll open up when the companies aren't even trying, in the case of GM.
Yeah, how much do you look at, Yari? You know, car makers, frankly, have had a dismal run, full stop, in Europe for a number of reasons. How much do you look at the car makers, the manufacturing sector, as I guess a benchmark or a blueprint of what Europe needs to do to fix it overall?
Yeah, I mean, I think it's clearly been under pressure in the firing line for a while. I think you've kind of seen both cyclical effects, but also structural forces, headwinds. I mean, the auto tariffs obviously would be another negative on top of that. But I would also say it's pretty widely expected at this point. I would also say, you know, reiterate a point made earlier that a lot of the production of German cars is actually in the US, to the US market and so on. So you kind of need to take all that into account. And the macro effects, I think, of these car tariffs are clearly negative, but not as big as some of those broader uncertainty effects we talked about earlier. I would mention one other point that I think is interesting in conjunction with the German fiscal package, which of course is raising spending massively, as we heard earlier. And there's a big question around capacity. Does the German economy actually have the capacity? And one sector where there clearly is capacity is in manufacturing and in cars. And so I think that's going to be an interesting question for the next couple of years, to what extent Germany can kind of repurpose some of the spare auto capacity, into other sectors, into defense, into sort of other manufacturing goods.
Craig, I'm looking at Tesla. Why is it doing so badly in Europe?
I think, people jump to Elon's politics potentially being at play here. I think we're going to find out in the next few months just how much that is having a real impact and how much of this has been a really important changeover that they have within their lineup. The Model Y was in need of a bit of refreshing. It debuted back in 2020. They've redesigned it, and that was going to cost them weeks of production in the first quarter. And it takes time, of course, once you've done that changeover for that production to ramp back up. So really dismal start to the year for the company in Europe and honestly globally. I think the first quarter numbers, there's real concern about that report coming next week from the company, just how bad the numbers are going to be.
I also wanted to really focus on the UK because of the spring statement, but I don't know whether there's a difference in terms of car usage in the UK compared to the rest of Europe. But spring statement, of course, tomorrow. It's quite exciting to see the changes that the Chancellor may or may not put in place. Does she restore her fiscal headroom? I mean, does she have any other choice, frankly?
Well, so I think the spring statement really is about the updated OBR projections and then how the Chancellor responds to that to restore headroom. So the updated projections are likely to show pre-measure somewhat negative headroom, mainly because interest rates have gone up since October. And then the Chancellor is expected to respond to that by trimming some of the spending commitments. So I think the comments imply it's very unlikely that she's going to change either the fiscal rules or raise taxes for this event. So the signaling has been in the direction of some welfare spending cuts, some departmental spending cuts to the tune of 10 to 15 billion, which would then roughly restore the headroom, the pretty small headroom, but the headroom that we had in October. So I think that's quite likely for tomorrow. But in some ways, the bigger question is, of course, where we're headed for the rest of the year and into the budget in October and what the fiscal pressures are going to be for the rest of the year.
I mean, how does this country grow, I think, is the ultimate question that, investors will want to know. Is there a clear blueprint from the government reducing some of the planning, even reducing regulation, that you think will really kickstart the UK?
Yeah, I think in the near term, what will be important will be to get lower interest rates coming through. So I think a priority at this stage is not to jeopardize Bank of England rate cuts by, for example, raising taxes that could have inflationary effects. So I think that could give you a little bit of leverage in terms of growth over the next few quarters if the Bank of England does cut as we expect them to do. But longer term, obviously, the productivity growth statistics are poor. I think two areas that the government has talked about are planning reform, as you mentioned. I mean, there's the mechanical effect of building more houses that helps GDP, but actually the more interesting effect is if you allow workers to move towards big cities where productivity levels are higher. So you want to try to create scale effects and boost productivity growth that way. So I think that's one interesting initiative. And then the other one is, of course, around trade, closer trading relationship with Europe, where most estimates would suggest you can get some productivity lift from that over the coming years. So I think those are the two longer-term initiatives to focus on.
And Craig, I mean, if you look at, the buying of Teslas as a benchmark of wealth, are the Brits buying new EVs?
I do think it's interesting. I mentioned, Musk's politics, and of course he's inserted himself both in Westminster and in Berlin, right? And it has been interesting to see, in the early goings of this year, they've actually had a bit better of a time here in the UK versus Germany, and it's been pretty dramatic. Where in Germany we've seen 70+% declines versus relatively moderate gains here in the UK. That may have something to do with the fact that they are highly reliant on Chinese production for this market and maybe had some inventory to work with earlier this year.
So interesting. Thank you both for joining us. Yari Stender, Goldman Sachs' chief European economist and Bloomberg's global autos editor. We like calling him the Auto Tsar, Craig Trudell. Coming up, we'll be joined by Rishi Khosla, co-founder and chief executive of Oak North Bank. We discuss the fintech environment, head of the UK spring statement. We'll also talk about loans and some of the tariffs, what kind of impact he sees for the companies they service. This is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice, my conversation, my poetry, you know.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top headlines. More trade uncertainty as President Trump says auto levies will be announced over the coming days. Now, he also appears to invent a new economic threat, warning of secondary tariffs. Tesla's dismal run in Europe continues with a 40% drop in sales in February. Car makers on the continent also see a broad drop. Plus, HSBC targets growth in Asia and the Middle East after exiting key businesses in Europe. And the U.S. will have more of our exclusive interview with the chief executive, George El-Hadary. Now, it's also crunch time for Rachel Reeves as she's set to announce billions of pounds of spending cuts in her spring statement on Wednesday. Now, it will be a make-or-break moment for the Chancellor, who had promised stable public finances and a single major fiscal event a year. For more on this, we're joined by Philip Aldrich, Bloomberg's senior UK economy reporter. So thank you, Phil, for joining us. I feel like every time you say make or break, it's make or break. But actually, this is going to be a quite delicate one because she promised cuts, which she probably can't deliver.
Yeah, it's a tricky one. Obviously, she's going to supposedly make about £10 billion of cuts. Some of it will probably be done within the spending review envelope. Some of it will be in the final year, which is always being characterized as a fiscal fiction because these don't have to be sort of costed into departmental spending plans. But some cuts, I think, will be taken off the envelope and be real. And so departments are going to feel it. And obviously, you're already getting a backlash from Labour MPs about the welfare cuts. We're going to see spending cuts in some unprotected departments in particular. There's likely to be more complaints about that.
Yeah, so, I mean, she's facing pressure, frankly, from all sides, right? The public, MPs, millionaires or billionaires. Like, how is she going to land the plane?
Well, I think that there's one constituency which they've become really focused on, and that is Bloomberg's sort of core client base. It's the markets, right? Everything went a bit wrong back in October because she left herself so little headroom. There was no insurance against any sort of changes in market interest rates or any changes in the sort of economic outlook, and that has basically been the sort of backdrop to a lot of the problems since. So one of the key things she's going to do is restore the headroom because she's effectively she's lost about 15 billion. She's at -5 is where she starts, having been at plus 10 billion pounds in the October budget against her fiscal rules. She is going to, we think, going to restore that headroom, which will provide some reassurance to investors that she is focusing on this economic stability that she says all of the growth plans that they have are built upon. So I mean that's basically the bedrock for what they're going to be announcing next week to try and rebuild confidence in their plans.
Yeah, so because the spending review is the big one. I mean, there's so many, like, what is actually the biggest for her? There's the OBR, there's spring statement, and the spending review.
Well, I guess this is this is the biggest immediate issue because the OBR is going to cut the growth outlook. It's going to show that she did make a mistake back in October at the budget, and there is potentially going to be a warning that this is just a prelude to even worse forecasts in the autumn budget. The OBR has got this heroic assumption about productivity. Should they downgrade their productivity forecast, it will blow a hole in her numbers, come October, November time again. So, this really is the key event. The spending review is going to be ugly politically because it's at that point that you start to identify who's going to bear the burden of the cuts. And then people will really see what's coming through in public services. But in the meantime, there's also the details of the welfare cuts that they outlined last week, where we'll identify how many people and who are going to lose these benefits. And so Labour they're not elected to make people poorer, but the accusations are already coming out that they're going to leave some people who are already poor worse off.
Yeah, it's going to be a definitely bumpy ride politically for them. Thank you so much, Phil Aldrich, there, our senior UK economy reporter. Now, a reminder that we'll also have special coverage of the Chancellor's spring statement from 12:30 p.m. London time, March 26 tomorrow. Let's also discuss the UK's fintech environment ahead of the spring budget. My next guest is a co-founder and chief executive of Oak North Bank, a digital business bank for entrepreneurs. Now, as Labour tries to revive London's struggling listing market, Oak North has recently expanded its U.S. presence by acquiring a Michigan-based bank. Well, Chief Executive Rishi Khosla joins us now. Rishi, thank you so much for joining us. Now, first, I want to start about the UK, and then I want to ask you why you're so attracted by the U.S. lending market. But are you frustrated with the UK market? We have a new government in place. There's been a bit of up and down. There's a threat of tariffs. It doesn't look like it's a pretty picture.
So look, we set up Oak North really to help entrepreneurs, right, starting here in the UK. Over the last 9.5 years, we've helped create something like 56,000 new jobs through the lending that we've done to entrepreneurs in the UK. I think fundamentally the way to have a positive environment in the UK is to have growth. The best way to have growth is to have the human capital which drives growth, i.e. the entrepreneurs, right? So creating an environment which is very fertile to actually attract global entrepreneurs to come and set up in the UK, in various cities in the UK, in the same way that you have almost a dozen cities around the world which are setting up their stall to attract those entrepreneurs. I think that's what the UK needs to do much more of. It needs to lean significantly more into that contingent. And again, very specifically, I would call out those growth entrepreneurs versus the CEOs of big PLC type multinational companies, because their level of productivity gains that they give when they come in and invest is significantly smaller, although the dollars may be larger.
But Rishi, I mean, this is a problem, is that actually there was so much in the autumn statement from the government that it's unclear whether they're entrepreneur-friendly or not. They're trying to do things like, cutting planning, making things quicker, trying to revive growth, even, putting pension funds to put more money in UK companies, the smaller UK companies. At the same time, they increase NICs. So do you think they're business-friendly?
I mean, overall, you come out of the autumn statement and it's hard to say they're business friendly, right? I mean, absolutely trying to unlock the pension money to come into private companies, great. But over what period? Over 3, 4, 5 years? I mean, the challenge in terms of some of the measures from the autumn statement is that you cause an exodus of entrepreneurs out of the country, right? And you're telling global entrepreneurs that the UK is somewhat indifferent, right, or arguably even worse, to actually attracting you to come and establish your businesses here or grow your businesses here. Whereas I think we know what we need to be doing exactly the opposite. And, I'm forever the optimist, so maybe there's something tomorrow.
But do you think, I mean, again, have you seen an exodus of entrepreneurs saying, look, I'm going to look for capital elsewhere, I'm going to be... I mean... Is it easier
100%.
to do business in the US?
There are so many cities, again, I specifically call out cities versus countries, cities which are setting up stall, right, to attract those entrepreneurs, and whether that's Milan, whether that's Abu Dhabi, whether that's Singapore, whether that's various US cities, New York, Miami, etc., Austin. Like, there is a lot of incentives and effort going in by those cities to attract those entrepreneurs. And do we see them leaving from the UK? I mean, the stats, I think, which are shared from Henley and Partners at least, shows that the UK had the largest loss of millionaires after China. And obviously, we're sort of, a 20th of the population, if not less, of China. So that's a pretty stark start.
Rishi, does that hurt your how much does that hurt your business actually in the UK? I know you're also looking at, but listings. What would it take for you to list here?
So look, we continue to grow here in the UK. We continue to support British entrepreneurs, right? In terms of overall size of our business today, compared to market size, we're less than 1% of the market. So our ability to continue to grow, and there will always be great entrepreneurs to support, and we're there to support them. So does it hurt the business? I would say it doesn't hurt the business. We continue. And yes, we are expanding in the US, right? And we have been over the last 2 years or so. And that continues to go incredibly well. In terms of listing, who knows?
Who knows? Very diplomatically put, you recently acquired Community Unity Bank. This is a U.S. bank with a license. Why buy a bank with a license instead of looking for your own U.S. license?
So number one, we signed the deal subject to regulatory approvals. So closing will be whenever we go through, get past the regulatory approval process. Why buy a U.S. bank rather than go through a de novo process? Fundamentally, we found a relatively small bank which had an excellent team, which had already gone through the process and had just a very aligned culture and view of the world. And therefore, that acts as a small springboard to our plans. Fundamentally, I think the assimilation of that team into our culture is one which is going to be easy and therefore very logical.
Rishi, what's drawing you to the U.S. market right now, given these tariffs and some of the uncertainty surrounding the U.S. market globally? I have to say, but also the U.S.
I was going to say, look, we started the business since September 2015. There's only been uncertainty, like obviously with Brexit in the UK, and then all the way through to today. So living in an uncertain environment, I think, is just the new norm. And fundamentally, if you look at the US market, it's over $4 trillion versus like $500 billion in the UK for us. So in terms of just general market size, it makes sense to play that. And also the US has evolved in terms of moving away from pure bank funding. And as Oak North, combining private credit, fintech, and commercial banking elements for our customer base, it's sort of the US is a market which already accepts alternative finances. So ultimately, a great place for us to expand.
How much do you want to grow in the US?
A lot.
What's a lot?
I mean, look, we've been, if you look over the last several years, the business has been growing about over 20% a year very consistently. Right? I think our baseline is to continue that growth profile over the next years. Obviously, that means much higher growth in the US comparatively off a smaller base. So continuing that overall trajectory.
But is it because you actually found a gap in the offering, or is it because you just think the pie will grow for everyone?
There's absolutely a gap. In the whole idea behind setting up Oak North was the fact that banks generally focus very well on either retail customers and consumer customers and micro businesses and or large businesses. And in the middle, you get this whole contingent which just gets, in a way, underserved, overlooked. And it's that market, the lower middle market, the missing middle, which is our core focus. And that's the same in the UK, it's the same in the US, it's the same in pretty much every market. So there is a gap, and ultimately that gap, in our view, is the highest productivity element of any economy, because that's where the growth businesses are.
Yeah, I mean, again, in the middle of tariffs, it's not an obvious choice, right? It's a brave choice, I would say.
Setting up the third new bank in 150 years in the UK was a relatively brave choice. So,
what surprised you the most since you set it up?
You know, it's just been the ease of actually getting into the market and the velocity under which we've been able to build. So we are already about 3 times the original plan that we expected in the US. So just the velocity of activity in the US is just very significant, even in environments which are bumpy. Like just the entrepreneurial spirit, those animal spirits are just so strong.
I know you won't say much, but are you thinking about IPOing, or is it not, one of your priorities at the moment?
Look, the last time we raised equity capital was 6 years ago. We've been profitably funding our growth ever since, and really since we started the business. So it's not an imperative.
And the markets is volatile. I mean, does that come into your thinking, or also your clients' thinking?
I mean, look, the way the public markets have evolved over the last decade has just been relatively adverse for issuers, right? If you compare it with where it was. So if you look at liquidity, if you look at sort of passive versus active, et cetera, you look at the volatility levels, you sort of say, if you need to, it makes sense. But ultimately, if there's a choice, you evaluate options.
Yeah, and it feels like private companies actually have been doing okay. I don't know whether, again, that conversation has changed over the last couple of years for you.
I mean, ultimately, being a private company, I think, has a lot of benefits. Again, if you're a consumer-facing business and being public actually gives you a massive branding uplift, or if you're a continuous issuer, you need to continue to fundraise, totally different. The capital markets actually work extremely well. But actually, if you don't have those dynamics, being private actually takes away a lot of noise.
Rishi, thank you so much for joining us today. That was Rishi Khosla there, the co-founder and chief executive of Oak North Bank. Now, the chief executive of HSBC has told Bloomberg that he plans to double down on investment bank operations in Asia and the Middle East after exiting key businesses in Europe and the U.S. Well, Georges Alideri says restructuring will save $1.5 billion. We spoke to him exclusively at the bank's Global Investment Summit in Hong Kong.
So what we announced is we will be incurring about $1.8 billion of cost, essentially severance cost.
Okay.
That the saving, most of the decisioning for that will take place this year. Most of it will take place in the first half of the year. That the benefits will start materializing this year, where the $300 million benefit will come this year. That the benefits will materialize in full by the end of full year 2026. So the full year 2027 will benefit from the full $1.5 billion saves that we're targeting. What we also committed that these will be permanent saves going forward, and that we're taking these saves straight to the bottom line.
Okay.
So it's a payback period of effectively roughly 2 years, but it's a permanent benefit that we will achieve.
And then the other component there is a further $1.5 billion, which I was looking at your earnings statement, and it was page 11 or 12, I think, of the strategic review. And the way you phrase it there is a reallocation of those costs into growth businesses. So I think it's a two-part question I have is, if you're reallocating costs, is that a net savings? Is $1.5 billion net savings? And what exactly are you looking at doing? Because there's not a lot of detail on that.
Yeah. So the organizational simplification benefits, which are efficiency saves, not impacting revenue in any material shape, $1.5 billion, those will be taken to the bottom line. That's the first $1.5 billion.
Yes.
Now, additionally to that, we're also looking at the what we do and recognize that there are further focus that we can achieve in our business, where we will be taking $1.5 billion from activities that we are currently doing that are either non-strategic or non-returning, and we will reallocate them. We'll reallocate these $1.5 billion as we materialize the saves. We'll reallocate them back into areas where we have competitive strength, where our customers expect us and need us to be, where we can generate good returns, and where we have greatest opportunities to grow. This second $1.5 billion, the revenue we will lose against it because we will be stopping activities.
Those units, those assets, yeah.
Those assets. We expect to be able to generate better quality revenue instead, because they're more strategic or higher returning.
And have you told your team, have you given a timeline for that second tranche of?
Yeah, we expect to do it in the medium term, but there are a number of these initiatives which we already communicated to the market. For instance, about $300 million of this $1.5 billion will be delivered through our decisions around investment banking, in particular M&A and ECM in Europe and in Americas, where we're basically scaling down this activity. And others will come from other inorganic activities, such as the sale of our German private bank business, the sale of our French insurance business, Bahrain retail business, etc.
Looking at the timing of perhaps, and I know it's under review, so I'm not sure how much detail you could give at this point in time, but you mentioned a lot of those decisions will be made over the next few months. And correct me if I'm wrong, I think the timeline you gave was you want to complete the review by June of this year. When do you think you'll be able to make meaningful announcements?
So with regards to the efficiency saves, most of the announcements are done. The rest is execution. We will be able to talk to how much we've decisioned. But again, we have committed to achieve these saves by the end of full year 2026. So we're working on that timeline.
Right.
With regard to the reallocation of costs from non-strategic or low-returning areas to strategic, areas of stronger competitive advantages and higher growth prospects, and obviously higher return prospects, We will announce as and when we have something to announce. So as I said, I've shared with you some of the ones that we've gone public with, and then the rest, as and when we're ready to announce, we will make it public.
I mean, suffice to say, then you're happy with your footprint, or if not, looking to increase your footprint here?
Absolutely happy with our footprint.
What about investment banking in Asia Pacific?
Absolutely happy with our investment banking in Asia Pacific. Look, for the investment bank, we obviously want to double down on all our capability around debt. That's debt capital markets, leverage acquisition finance, and other financing activities, because that's the heart of everything we do globally. And in regards Asia and the Middle East, we want to also double down our capabilities in M&A and ECM. So the exit that we're processing now in Europe and the Americas is to allow us to focus at the areas where we can really be differentiating to our customers, where we play to our competitive strength, and where we really bring value.
Well, that was the HSBC Chief Executive, George El-Hedary, speaking exclusively with Bloomberg's David Ingles. Coming up, how Google is reshaping its search engine around AI in the face of competition from ChatGPT. We'll have more on today's Big Take next. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Wednesday, UK Chancellor Rachel Reeves delivers the government's spring statement. How will she fix the hole in the UK's finances after her fiscal headroom was all but wiped out? And will she be able to keep her own fiscal rules? Live from Westminster, Bloomberg Television has special coverage, starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. Bloomberg. Context changes everything.
Now, the Airbus Chief Executive Officer, Guillaume Faury, says any potential tariffs between the U.S. and Europe could be more problematic for the plane maker's rival, Boeing. Now, Airbus's main factories are globally more spread out than Boeing's, which only assembles aircraft in the U.S. Now, in an exclusive interview with Guy Johnson, Faury added that he's encouraged there hasn't yet been talk of aviation-related tariffs.
No, we keep doing what we've been doing so far, relying on Alabama, indeed. That's a plant where we have 3 final assembly lines. One is not yet delivering planes, but the 2 others are. So we are procuring from everywhere around the world, assembling there in the US with US jobs, 2 US airlines as well. So I think we are key to the US ecosystem, to the aviation ecosystem, and we think that plays a big role in how tariffs are targeted.
Well, that was the Airbus chief executive, Guillaume Faury. Now, today's Big Take looks at how Google is reshaping its search around AI as it seeks an answer to rivals like ChatGPT. Google search has dominated the web for more than 2 decades, but is now being challenged by advances in AI. Well, let's get more with Bloomberg's technology editor, Olivia Solon. Olivia, thank you so much for joining us. So how is Google's core search product evolving in response to the rise of AI chatbots?
Slowly, I think, is the quick answer. It looks like Google's been talking about shifting its search to more of an AI chatbot style model for years, even before the launch of ChatGPT. But there's been a lot of internal resistance for various reasons. Search is the company's cash cow, so management's been reluctant to do anything to disrupt that. But last year, with OpenAI and others snapping at its heels, Google appointed a new lead for search, a woman called Elizabeth Reed, and she's been really shaking things up. And so that's why you're now starting to see things like AI overviews and chatbot-based search.
So, Olivia, what does that mean for its advertising-based business model?
Right. Well, Google, as you know, makes most of its money from companies paying to place their ads against organic search results. I think it's about 60% or 200 billion of its annual revenue comes from that. So if you're delivering the answer, like in an AI form of an answer, instead of a whole page full of links, you lose that screen real estate that you were using to place ads. And you also lose that attention of the people spending time clicking in and out of links trying to find the answers to their questions. And the only way to compensate for that is to charge for an AI-enhanced version of something that people kind of expected to be free.
But so how about publishers who have designed their sites for Google discoverability?
Well, AI overviews and sort of chatbot-style search effectively hijack the content from publishers, so people don't have to click through to their websites. Most websites rely on that traffic for ad revenue and subscriptions, so they're understandably not all that happy about that and have seen that traffic massively drop off. And without that traffic, there's a kind of less of an incentive for those publishers to make high-quality content if Google's just going to repackage it and serve it directly. And so this could mean a further deterioration of the overall information ecosystem that's ultimately used to train the AI models that deliver those chat-based search results.
And Olivia, the chairman of Alibaba has warned of an AI data center bubble. Is there one?
Well, he certainly thinks so. He's saying there's been a rush to finance and build out data centers for AI without really seeing the customers secured. And we've certainly seen these huge CapEx spends from companies like Amazon, Alphabet, and Microsoft, who are allocating hundreds of millions of dollars together to build digital infrastructure. And this is all while everyone's still kind of figuring out the real practical utility of some of these new AI tools. And then at the same time, we're seeing companies like China's DeepSeek launching AI models that claim to use a fraction of the compute power to train them. And so there are sort of further questions, first of all, about the utility of AI in the first place, and secondly, about whether it even needs all of that compute power at all.
Okay, Olivia, thanks so much. Bloomberg's technology editor, Olivia Solon. Now, later on Bloomberg, we'll also be speaking to the Shell CEO, Wael Sawan. That's at 7 p.m. London time. Now, this is the picture overall for markets. A lot of the focus, of course, on tariffs and what is happening there. Shell also giving a bit of a lift to a lot of these commodity stocks in Europe. Up next, to Bloomberg Surveillance. This is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about over-regulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
The word we keep hearing is the word uncertainty.
You still have a lot of uncertainty out there, even after April 2nd.
There is some wait and see out there.
As we get more clarity, I think markets will be able to get on with whatever is the destination.
The next couple of months is going to be a really rocky road.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday with equities attempting to hold on to recent gains as President Trump teases a lighter touch on tariffs.
Well, I may give a lot of countries breaks, but it's reciprocal, but we might be even nicer than that. We may take less than what they're charging because they've charged us so much. I don't think they could take it. In other words, they've charged us so much that I'm embarrassed to charge them what they've charged us.
Negotiations ramping up in Washington. The EU trade chief is arriving to meet with the Commerce Secretary Howard Lutnick, kicking off a flurry of talks in the run-up to April 2nd, when Trump plans to reveal so-called reciprocal tariffs. Later on this morning, another read on how consumers are feeling about next week's deadline. Consumer confidence due at 10 a.m. Eastern Time.
Which is going to be really important to understand just how much the consumer is pulling back or saying that they're pulling back at a time when the other economic metrics that are coming out of the United States are actually turning upward, are actually pretty positive. So if you see this soft data that continues to diverge, it'll keep that concern still in markets. If not, watch it go to the moon and people pile back into the exceptionalism. So
we're just over a week away from this Liberation Day, April 2nd, these tariffs. And what I gained from President Trump yesterday is that he seems to be in the mood for making deals and he seems to be flexible. 3 key meetings. You have the European Union trade chief coming to town, meeting with Jameson Greer and Howard Lutnick. You have a U.S. delegation going to India. They're looking for exemptions. And then Jameson Greer is supposed to get on the phone with his Chinese counterpart this week. Potentially, we could see deals done before April 2nd.
You could really sense the whole market just sort of exhaled in yesterday's session. This is what we heard from the likes of Evercore and Julian Emmanuel. The bull still lives as Tariff Liberation Day approaches.
Yeah, and it wasn't just Julian Emmanuel. It was also people from J.P. Morgan and Morgan Stanley that came out and said, well, probably has been a bottoming out that we've seen in sentiment. J.P. Morgan came out and said the risk of another violent unwind should be low in the short term. It's raising questions about whether we have already rebalanced this sort of momentum unwind, whether people's just sort of foray into Europe might be maybe a little exhausted, and people are starting to come back to the
I caution some people on just basically wish casting Liberation Day light, though, because one thing Trump did say yesterday was that sectoral tariffs are still going to be coming, whether it's the automobile industry, pharmaceuticals, semiconductors. He said he will be in the next few days, either before or after April 2nd, those tariffs will also be coming into play.
We've said it repeatedly on this program, the situation is fluid, very fluid. One single name to look at every single morning at the moment, Tesla. Tesla Tesla's had a nice bounce off the lows, a really nice bounce off the lows of almost 25%. Tesla this morning down just a touch. We're down a third of 1%. The latest sales numbers out of Europe, once again, a big disappointment.
Down 40%, even as some of the competitors are seeing increases to their sales. I'm looking at not just Chinese manufacturers, but also Renault, as well as Citroën, who have these cheaper models of electric vehicles that are selling at a significant pace. It raises a question. First of all, do we now care about deliveries for Tesla? And that seems to be a question for some of the people who are bearish in this name. And second of all, how much does the rhetoric out of the White House indicate real concern on the part of Elon Musk and Donald Trump on some of these protests that we're seeing around the world?
That stock is down by 0.4%. Tom Naran of RBC joining us later on the program to break down some of the challenges that company faces. For the broader market, equities just a touch softer. We're down a tenth of 1%. Coming up this hour on this program, Emily Babasog-Hill of Babasog Capital Partners with stocks on a two-day winning streak coming into Tuesday. Alex Norrister of the Cato Institute as trade negotiations kick off in Washington. And Claudio Irigoyen of Bank of America after downgrading his global growth forecast. We begin this hour with stocks steady after one of their best days of the year so far. Emily Babasog-Hill of Babasog Capital Partners writing, we have shifted from a moderately bullish outlook to a neutral/bearish viewpoint. It is too early to add back to US equities. Emily joins us now for more. Emily, welcome back to the program. It's been too long. Let's just get to that final point. Why do you believe it's too early to add back to US equities?
Well, I think we had a really good earnings season and saw 18% growth in S&P 500 earnings, year over year. But the guidance that many companies issued raised red flags. And I think that guidance was really not taking tariffs into account. And so the projections for the S&P 500 over the next earnings season at about 11%, frankly, it's a pre-tariff number. So our concern is that the American consumer and American businesses are expressing, serious problems with confidence and with expansion plans, et cetera. And while a lot of times consumer sentiment does not necessarily translate into consumer spending, our concern is that this time it will. Now, I would say that we're neutral to slightly bearish. So I imagine the S&P 500 ending the year at about 6,000. But I think there's a lot of volatility ahead.
Just to pick up on your first point, which parts of the equity market do you think are more vulnerable to that viewpoint? The airlines did come out and say things were pretty bad through the middle of February in the first quarter. The retailers have given us some pretty weak guidance as well. Where do you think is more vulnerable, given the lack of guidance you believe we haven't had?
Well, airlines, Walmart even, places that people go when, they're not exactly big spenders. And as you likely know, about 50% of our consumer spending right now comes from the top 10%. 10 years ago, that was 36%. And I mean top 10% in net worth and income. So I think it wouldn't take a lot if those higher end consumers started to cut back, that would have a significant effect on consumer demand.
Emily, just to put this into perspective, you turned neutral to moderately bearish late last year and early this year before the inauguration of President Trump, before there was a lot of the discussion around tariffs. Can you talk about why and how much of this was just what we saw in the economy versus the overhang of tariff concerns?
To be clear, we turned bearish in the first 2 to 3 weeks of this administration. And, I think it's important, for the most part, politics do not affect markets, or at least haven't in this country. But I would point to what we saw in Turkey over the last week. And so I think that's the test case of when politics can start bleeding into market performance. And I think the kind of uncertainty that's being created by the chaotic tariff policy is something that has to give anyone pause. And quite frankly, we're in the process of destabilizing a world order that has redounded to the U.S.'s benefit for 80 years. If we break it down and look at, country by country, India, Brazil run a very significant trade deficit. There's certainly an argument that there should be some fairness there. But on balance, we have benefited. Look at our economy over the last 80 years. And I think what we're doing is going in and destabilizing a system that has been very good for Americans and very good for our stock market.
One of the biggest surprises this year has been that the United States doesn't seem to be at least the stock market winner so far of the tariff discussion, and the rest of the world seems to have benefited more. And I wonder what the logic is behind that. Is it just simply some of the fiscal plans, or is it a complete 180 in terms of a belief that if the U.S. puts on tariffs, the U.S. gets hurt more than the rest of the world?
Well, frankly, I think we're engaging in, and by the way, I have a PhD in history and did my dissertation on the 1930s. So I have a slightly different cast to this whole thing. But frankly, the Trump administration argues that they want to run the country like a business, prize growth and efficiency. And what we're effectively doing is in 2 months, destroying our brand. This is reminding me of, Budweiser and the transgender ad. And overnight, Bud Light went from the #1 selling beer, to 3 or 4 or whatever it is now. What did we get for that brand destruction? And so, I think one of the reasons that we're seeing capital leave the U.S. and that we're seeing a resurgence in European stocks is effectively what we're doing from a power politics perspective is we are creating alliances against us. Europe, look what Germany just did. They're putting €1 trillion into their economic system. They're all going to have their own defense spending infrastructure. And remember, it was in the 1960s, that was part of the nuclear non-proliferation deal, that the Europeans were not going to have nuclear weapons. Now we're going to see a resurgence in Europe, both with the rebuilding of Ukraine and with the need for them to all essentially have their own defense forces.
Emily, I noticed
I think there's a reason for it.
You're looking elsewhere, and right now, 2 months into this administration, really only have one pillar of the 3 that the Trump administration says that they want to enact: tariffs, deregulation, and the extension of tax cuts. When would you want to get back into U.S. stocks?
So the reason that we're neutral to slightly bearish rather than bearish, because if you heard everything I've said in the last 2 to 3 minutes, you would think that I was a bear. But there are some significant countervailing forces, and I am going to answer your question, that I think could save the bull market, okay? One of those is that our economic fundamentals are still strong, right? Number 2, my firm's thesis that we're in the middle of a post-pandemic roaring 20s driven by AI productivity boost and innovations in other sectors, including the green energy transition, that's a very powerful force for growth, and that could save the bull market. And, third of all, our economy proved very resilient during a period of rising interest rates. No one thought it would do as well as it has, and it's very possible that it'll sail right through all of this political chaos. But the final thing is, I do think deregulation and tax cuts will flow through into corporate profits. The question is, and especially deregulation, the question is, can that happen soon enough? And how much of an impact is it going to have? What we're really talking about doing, or what the Republicans are talking about doing, is extending tax cuts that are already in place. And it's going to be a $4 trillion plus tax bill. So, so I think if they can pull that off, that's another of the 4 factors that would save this bull market.
It's a good point, Emily. It's good to see you, and great to catch up again. Emily Bowersock,
good to see you,
of Bowersock Capital Partners. A cautious outlook, but ultimately one where equities could continue climbing. We have found a bear. Max Kettner, HSBC, with another big change over at HSBC out of London. We're now underweight the US across the board. That's IG credit, high yield credit, and equities too. It's no longer about Goldilocks, but whether the sentiment shock of the over the last couple of months will spill over into more US hard data weakness. Uncertainty is high, but tariff noise is likely to extend beyond April 2nd.
Yeah, from ultimate Goldilocks, super Goldilocks, to pain and no gain, and this sort of shifts in the near term. I would love to speak to him over longer term what this means, but right now, this is what we're hearing from a lot of people. Why accept the risk premium associated with tariff noise, which we've been getting?
Equities a little bit softer this morning. We're down by 0.2% on ES S&P 500. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Senior foreign officials and major tech companies are pushing the Trump administration to rethink its chip strategy. Sources tell us that companies like NVIDIA and Oracle are pushing to repeal a rule that restricts exports of AI processors to most nations. Elsewhere, Hyundai has announced plans to invest almost $6 billion in American manufacturing. That includes a new steel plant in Louisiana. Hyundai also announced plans to spend about $21 billion through 2028 to increase U.S. production, confirming our earlier reporting. President Trump said that it's a clear signal that tariffs work. The Atlantic's top editor says that he was added to a text group where top U.S. officials discussed plans to bomb Houthi targets. Jeffrey Goldberg says that he received a connection request via the encrypted messaging service Signal from National Security Advisor Michael Waltz. The White House acknowledged the breach, but downplayed its significance. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny later on in the hour. Up next on the program, the countdown to April 2nd.
That'll be reciprocal tariffs. But we may take less than what they're charging because they've charged us so much. I'm embarrassed to charge them what they've charged us, but it'll be substantial. And you'll be hearing about that on April 2nd.
That conversation just around the corner. We'll be catching up with Alex Norista of the Cato Institute in just a moment from New York City. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Equity futures here a little bit softer. We're down by 0.1% on the S&P after a decent day of gains. On the Nasdaq, we're down by 0.2%. The Russell underperforming here, negative by 0.4%. Yesterday, for a moment, a collective sigh of relief on Wall Street. Max Kettner of HSBC is not buying it. Out with a note just moments ago, underweight the U.S. across the board. It's no longer about Goldilocks, but whether the sentiment shock will spill over into more U.S. hard data weakness. Uncertainty is high, and that tariff noise, he says, is likely to extend beyond April 2nd. Under surveillance this morning, the countdown to April 2nd.
It's going to be everything, but not all tariffs are included that day. For instance, we'll do some, as you know, we have already done steel and aluminum, and that's at a 25% level. And we are going to be doing automobiles, and then April 2nd comes. That'll be reciprocal tariffs. But we may take less than what they're charging because they've charged us so much. I'm embarrassed to charge them what they've charged us, but it'll be substantial. and you'll be hearing about that on April 2nd.
So here's the latest this morning. Countries rushing to offer concessions in the run-up to President Trump's April 2nd tariff deadline. The EU trade chief is heading to Washington today for a high-stakes meeting with top economic advisors. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the program. What's in play today for these trade chiefs?
Well, John, we know that President Trump is looking at those countries that have no tariffs, low tariffs, or run a trade surplus with the U.S. as potentially being up for these exclusions. But also, we know that he's considering whether or not countries have been cooperative or combative when it comes to these negotiations. Today, the EU trade chief meeting with Commerce Secretary Howard Lutnick and the USTR Jamieson Greer. There is heightened momentum to this meeting after President Trump yesterday said that he was going to move to impose auto tariffs in a matter of days. That, of course, is going to heighten these talks going forward. Our reporting indicating that Bloomberg News reporting indicating that at the moment, the EU could be holding off on some immediate retaliation in favor of kicking it to later that month in hopes of making progress when it comes to these talks. There's a slew of other ongoing negotiations happening this week. For example, an American delegation just touched down in India, and we also know that the USTR Jamieson Greer will hold a talk with his Chinese counterpart at some point this week. John, that is going to also have heightened pressure against it after President Trump yesterday moved to impose a 25% tariff on any country that imports Venezuelan oil or gas. We know that will hit China particularly hard as a top importer of Venezuelan crude and already has that 20% levy imposed on it across the board.
Tyler, when it comes to these countries, they're really rushing to try to strike a deal before April 2nd. Can you walk us through some of the sequencing potentially the president was talking about yesterday when it comes to reciprocal versus sectoral tariffs?
Right. So, Anne-Marie, we know those reciprocal tariffs are now up for some potential country exclusions. And then he sort of laid out a timeline, if I could call it. He said when it comes to auto tariffs, those could be coming in a matter of days. He said when it comes to pharmaceutical tariffs, those could be coming in the very near future. And then when it comes to chips and lumber tariffs, those could be coming down the road. So it seems that those auto tariffs are indeed next on deck, and those will particularly hit the European Union hard. We are starting to glean some details about what concessions could look like. And that is why we have to keep in mind that these reciprocal tariffs are taking into account not just tariff barriers, but also those non-tariff barriers. Take, for example, Anne-Marie, Bloomberg News reporting that the United Kingdom is considering rolling back potentially or abolishing its digital services tax. That would be a big win for this White House after the first Trump term failed to see our European allies roll back their DSTs. So that could be something on the table when we are talking about potential concessions looking ahead to next week.
Hey, Tyler, good to hear from you. As always, more from Tyler Kendall later on in the program. They're the kind of things we want to hear. We'd like to hear more of that a little bit later between the European Union and the United States. We'll see. But ultimately, this is the point that Max Kettner of HSBC is making this morning. This uncertainty is likely to persist.
It's a feature, not a bug of this administration. And what Tyler really was showing there is that Trump's coming in with maximalist demands, whether it's on VAT, whether it's on digital service tax, saying he wants concessions on all of these issues. And what do you see today? The European Trade Commission coming to Washington, D.C. to try to strike a deal before he comes out with his plan on April 2nd.
Here's one take from Alex Norristar of the Cato Institute, writing, "We don't know the scope yet, and the uncertainty adds another layer of danger, but it would be a mistake for other countries to reciprocate with higher tariffs." Alex joins us now for more. Alex, welcome to the program. Do you think those countries are going to take your advice?
Probably not. They haven't taken it so far, but I do think it's hopeful that the Europeans are probably going to delay any kind of reciprocal tariffs for at least a period of time. I mean, tariffs do an enormous amount of harm both to the country that exports, but primarily to the country that imports this. I mean, it's basically a tax. So we have a situation where the United States is threatening to harm their own economies, and I think it would be a mistake for Europe and these other countries to do the same.
What kind of exemptions can we see from the Europeans? Because the FT at one point was talking about weeks ago that they were going to lower the barrier when it comes to American autos going into the EU, and Trump has signaled that quite a few times from the Oval Office.
Yeah, I think that's primarily the big one is the autos, but also on the example of the digital services tax. I mean, that's been a big point of disagreement between the U.S. and Europe for years now. That's one where there could be some kind of concessions, but it's just important that these countries not overreact by going to the wall, by going to the maximum type of reciprocal tariffs. I mean, these are very damaging to everybody involved. So I just hope that everybody remains sober in responding to Trump's tariff threats and the actual imposition of these tariffs.
So we have the reciprocal tariffs on April 2nd, and then he's talking about sectoral tariffs as well. How are you thinking about both of these?
Well, I'm thinking it's going to do massive damage to the U.S. economy, especially to firms exposed to international trade, of course, in substantial ways, but also with supply chains raging across several different countries. I mean, supply chains make the effective tariffs even more devastating if a product in its intermediate phase of production goes across borders several different times. So this magnifies the potential damage for the U.S. economy and the global economy as a whole. I mean, it's important to remember most of the U.S. trade is with other developed countries, with Europe, with Canada, with Mexico, and countries that are close to us. So this type of damage, especially in North America, but also with our European allies, could be quite devastating for high-end manufacturers and other types of highly profitable American firms.
A lot of people would agree with some of the goals that President Trump is going for, including bringing manufacturing back to the United States, improving flow of trade, creating more domestic production of certain, particularly national security-related items. What do you think is a better way to do it?
I think a better way to do it would be to lower trade barriers to make it more attractive for firms to locate in the United States and take advantage of supply chains across the board. Also, I think pursuing tax reform under the extension of the Tax Cuts and Jobs Act, which is the big tax news this year domestically, making those rates lower, making the base broadening the base, as well as a substantial deregulation. We have seen the Trump administration pursue deregulation in terms of energy, some in healthcare, some in AI, and some positive tax moves, such as getting out of the OECD tax treaty. So I think pursuing those types of responsible policies, as well as trying to get the deficit under control, would do a lot more to bring a lot of American firms, to reshore American production, but also to convince a lot of foreign companies to bring firms over to the United States and increase production here. I mean, one thing to also recognize, right, is every tariff, a tax on trade into the U.S. is also a tax on exports. And if this administration wants to boost exports, wants to reduce the trade deficit, which really doesn't matter anyway as a number, they should not be leveling a tax on imports, because that will just reverberate to an effective tax on exports.
Just quickly, Alex, do you think that there's a chance that all of these negotiations will ultimately lead to a lower tariff rate and actually more closer trading ties with certain nations?
Let's just say that I wouldn't bet on that, but if that happens, I will certainly come back on here and eat my hat.
Alex, appreciate your time, sir, as always. We know what you'd like to see. Alex Norrestad of the Cato Institute there on the trade situation. I think in an ideal world, they would be negotiating lower tariffs across the board, and hopefully that's the start of something later on this morning down in Washington, D.C., but a lot of people at the moment concluding that's unlikely.
But also, if that's the start of a conversation, not the end, that just means uncertainty will be prevalent in this market for months to come, because he's going to constantly be in this flexibility negotiating mode when it comes to how he's dealing with trade partners.
If you're just joining us, welcome to the program. Expecting some negotiations later in Washington, D.C. between the EU and the United States. The EU trade chief sitting down with the Commerce Secretary, Howard Lutnick. And the equity market at the moment just about unchanged on the S&P 500. No drama. Over in China, there might be some. We're going to catch up with Shehzad Kazi of the China Beige-Book as global CEOs gather for the China Development Forum. From New York City this morning, good morning to you all. You're watching Bloomberg Surveillance.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Equities just about unchanged on the S&P 500, attempting to build on yesterday's gains. A two-day winning streak on the S&P, coming off the back of a mild week of gains. The gains yesterday unlocked by a more targeted approach from the President of the United States, potentially regarding trade, certainly teased a softer approach in some of the comments the President made in yesterday's session. In the bond market, that unlocked higher bond yields across the curve on a 2-year, 10-year and 30-year, and they keep climbing, up another 2 basis points on the session on a 10-year, 435.77 at the front end of the curve, up by 2 basis points to 4.05%. With that additional dollar strength, check out the FX market. Euro dollar at the moment trying to buck the trend after 4 days of euro weakness. Euro dollar pushing out some strength here, Lisa. Euro dollar 108.18.
Yeah, but still kind of trading in and around this range. It has been this sort of ongoing question about whether we've exhausted the momentum trade that had been the United States, that unwound into Europe. And that's what some people are saying is possibly some of what we're seeing right now across asset classes.
Could be a big test for the data over in Europe in the months to come, depending on how they respond to trade and the fact that it's going to take a while to deploy some of that fiscal loosening that we've seen out of Germany in the past few weeks. On our radar this morning, the Atlantic's editor-in-chief saying he was added to a text group where top U.S. officials discussed detailed plans to bomb Houthi targets in Yemen, the incident prompting fresh national security concerns.
Obviously, this is incredibly concerning. Obviously, this was very clumsy. One thing I will say, there has been very little interest in what has been going on in the Red Sea for more than a year, even though we have some 40,000 U.S. troops in the Middle East region. Yesterday, if you looked at the Google trends over Houthis, they spiked. It took this story about incompetence, about adding a journalist to a text exchange for people in the media to start actually being educated about what's been going on when it comes to the Red Sea.
There are a lot of aspects of this. You can look at this from a million different angles. A question about what kind of security. They probably shouldn't have been using Signal to talk about these things, but rather a secure room. In the framework of the negotiations that are ongoing in Washington, D.C. right now with Europe, it highlights the increasing tensions with real animosity in the White House, in the cabinet, where people are saying they need to pay their way and we're bailing them out again. And that was made transparent in some of these texts, which I think will complicate some of the discussions in Washington.
I agree with you. Just to build on that, I think we've got a decent idea of what was driving that decision. The kind of debate that was taking place behind closed doors regarding it, that trade channel was far more important for the Europeans than it is for US trade. And there was a belief, particularly from the Vice President, according to these reports, that he was upset about bailing out the Europeans again. But what really drove the decision? They were also equally as upset that the former administration hadn't provided a deterrence in the region. And this was an example, as far as they were concerned, that they were willing and able to do something about it.
Even though they have been very annoyed with Europe, and actually what I was reading there in text is basically the readout I have gotten from people about where J.D. Vance stands, the vice president, when it comes to Europe. He's probably one of the most isolationist part of that group. But at the end of the day, this group came together, and for collective security of global shipping, they were willing to put American lives lives at risk.
There's going to be a lot of questions about what happened there and how secure that data will be going forward from here. And on that relationship between the United States and Europe, check this out. Trade talks ramping up in Washington as countries rush to offer concessions ahead of April 2nd. The EU's trade chief set to meet with Commerce Secretary Howard Lutnick and Trade Representative Jamieson Greer a little bit later on today.
We should note that this is yet another meeting that Howard Lutnick and Jamieson Greer is having with their European counterpart. It was just a few weeks ago Howard Lutnick was on this program, remember? And Donald Trump came out and talked about 200% tariffs on European wine, champagne, and cheese. And Howard Lutnick said, I'm going to get on the call with my European counterpart. So these talks have been taking place. The reason why the talk today is so important, because we're a week out from April 2nd.
You can have a series of talks through the next 24 hours down in Washington, not just with the Europeans, but also with an Indian delegation as well. So look out for some headlines regarding that story. Check this out from China. Alibaba's chairman warning of a potential bubble forming in AI data center construction. The executive saying the rush to build server bases from the US to Asia is starting to look indiscriminate, and many projects are built without clear customers in mind.
There are a lot of ways to take this. One of them could be that Alibaba is coming out in a 1-2 punch after yesterday saying that they had come up with an AI program that also used AMD as well as Chinese-made chips. It also was efficient, kind of like the DeepSeek moment. So, hey, look at us in China. We're coming up with all sorts of technology that's going to render your $1 billion of investments completely obsolete. On the flip side, it leans into concerns that a lot of people have been saying, including the fact that Microsoft reportedly backed away from some of its investments. So it sort of builds on concerns that already are out there. I will just say, this is going to be the centerpiece of so much discussion down the line. Who is getting the upper hand and what tactics are the Chinese, U.S., concerns or competition when it comes to AI? What are the tactics that are being deployed?
Let's keep it on China. China's saying it is preparing for, quote, shocks that exceed expectations as it braces for more tariffs next week. Officials telling a gathering of global business leaders, including Apple's Tim Cook, the country should be opening up markets and sharing resources. Shehzad Kazi of China Beige Book joins us now for more. Shehzad, good to see you, sir. This feels like a new moment for China, a new phase for growth. There's a phrase that we use continually on this program, that the United States innovates, Europe regulates, China imitates. That last point on China no longer feels valid. It feels like China is moving into a different phase. How would you describe that phase now?
Yeah, I don't think that's been true for a while, because they've gone from just imitating to often, I think, being the place where a lot of the design is taking place, a lot of clearly the innovation is taking place. And I think it's taken that for policymakers out here in the U.S. to wake up and realize that business as usual can't carry on with China anymore.
If China no longer needs Western innovation in the same way it did many, many years ago, what does that mean for Western participation in Chinese growth? Corporate participation from the West into China going forward from here?
So they may not need it, but they certainly still welcome it and still would like to have it. On the other hand, of course, they rely on us as a market. So regardless of what they're doing on the innovation front, they need a place oftentimes to sell. And nobody's a bigger buyer in many ways than the U.S.
At the same time, there's an argument being made by a lot of U.S. companies that they want access to the innovation that's coming out of China. And we hear this from the likes of NVIDIA, that obviously has a vested interest, but we're also hearing this from the likes of FedEx and Boeing and Cargill and all these other companies that also do business in China. How valid are those discussions? I mean, how much are they operating as somewhat of the diplomats right now to the U.S. government?
Yeah, I think, industry is going to make all sorts of arguments, in order to maintain their access in China and have it be unfettered, whether it's this or whether they need the market or they need the revenue in order to do more R&D. These are, I think, a lot of this is just industry pushback on policies that, of course, don't work for them.
It's important to understand the economic context to this in China, and that's one thing that the Chinese book does so well, the China Beige Book. I'm curious how successful they have been with the recent rounds of stimulus in truly boosting consumption, which has been the key cudgel that's kind of gotten in the way of their being able to really recover.
So it's been very piecemeal, but I think a big chunk of that is because for now, they don't feel like they need to go harder. Now, once the tariffs hit, once the economy perhaps sees the impact of that, then they may get a little bit more aggressive on their consumer stimulus. But for now, they've done some trade-in programs. They've seen some benefits of that, and they've decided to live with the short boost to growth.
But some tariffs have already been hit. there's 20% additional tariffs on Chinese imports. This evening, this week, we'll have a call, Jameson Greer and his counterpart. What do you expect the negotiations to look like between Washington and Beijing?
I think, this immediate call may be just Beijing also looking for a lot of information because there's so much confusion, including within the Communist Party, right to the top in terms of just what the tariff policy is going to look like. From the U.S. side, of course, they're very interested in saying you need to make good on your phase one agreements to begin with. And then perhaps there's some discussion of what could eventually look like a phase two.
Well, phase one, shouldn't China have been doing that before Trump came into office?
Absolutely. I mean, in many ways, phase one was a total disaster from a U.S. standpoint. So making them go back and purchase all those commodities, I'm not sure how you pull that off. But that, I think, should warn you that any major deal with China is probably not workable at this time.
How workable are secondary tariffs? I'm sure you saw the headlines in the last 24 hours. How workable is that going to be?
Yeah, it's going to be hard. I mean, how do you go around, hitting them, and then, what do you do with countries that are your allies again versus a China or somebody else? So it's a tool. We'll see how effective it is.
So help me understand this. If you buy Venezuelan crude from here, you get an additional tariff from the United States on anything you're trying to purchase, or rather anything the U.S. is trying to purchase from you.
Yeah, it's an additional called secondary tariffs, which I've never seen secondary tariffs done with tariffs. I've only seen secondary sanctions. Say a secondary sanction, if you're Iranian crude, you go after the banks that are involved or the teapot that's involved in buying the crude. Now they're doing it with tariffs. There was nuance, though, to this executive order. The United States seems to have a little bit of freedom, and depending on what country they decide to put that secondary tariff on.
So China's a buyer of Venezuelan crude.
So China will be one of them, I'm sure.
And with that in mind, we're going to go from 10 to 20% to what?
45 or 50% if
Across
we
the
actually
board.
start doing that, yeah. But keep in mind, China's been buying Iranian oil this whole time. What have we done about that?
It's very hard to enforce. That's the problem, right? Until you decide to go after these ships, it's very challenging to enforce.
Shahzad, good to see you. As always, great to catch up to break it down. Thank you, sir. Shahzad Kazi there of the China Beige Book. Secondary tariffs is now something we've all got to grapple with. Are they actually going to enforce this? Will they actually move forward with this? Is this a threat? Because when it comes to China, never mind 10, never mind 20, you could have something closer to 50% across the board.
I guess it depends how bad China wants that type of Venezuelan crude, which is hard to get. It's not, easily accessible all over the world. What I would say is when it comes to things like secondary tariffs, which is new, secondary sanctions, it's the enforcement that is so challenging. We have had basically all of Iranian crude sanctioned throughout the entire Biden administration, yet they were shipping how much? 1 million barrels, basically, and, basically getting up their FX reserves because of it, because they weren't enforced.
Josh Lipsky over at the Atlantic Council had this interesting observation where he said that President Trump has been very critical of sanctions in the past and that will lead to de-dollarization. So it seems as though the idea of secondary tariffs is replacing sanctions as sort of the tool of choice. A lot of questions about enforcement. It indicates, though, the desire to have a similar effect, at least with the different tools.
Something the Treasury Secretary has said as well. Scott Bessent, not a big fan of the sanctions regime, thinks it's done the same thing to the US dollar, and we'll see if this is a new front for the trade war. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Airlines may seek legal action against Heathrow Airport after Friday's unprecedented shutdown. The Guardian reported that a body representing more than 90 carriers could take the airport to court if a settlement over the cost from the hours-long closure is not settled. Elsewhere, India is planning to seek an exemption from President Trump's reciprocal tariffs. Trump say that New Delhi officials will make the case when the two sides meet for bilateral trade talks today. India has already taken steps to appease the U.S. president. That includes lowering imported taxes on certain goods. President Trump says that he would welcome the Kansas City Chiefs to the White House, an unusual visit by this year's Super Bowl losing team. Trump said the visit would be to celebrate the Chiefs' 2020 victory, which they missed due to COVID. This year's Super Bowl champs, the Philadelphia Eagles, are planning a White House visit on April 28th. And that's your brief, John.
Danny, thank you. Participation trophy is not something I expect from conservatives. It's got to be winners and losers here, Bramo. Not everyone gets a prize.
Why just conservatives? I think there are a lot of people who think that everyone should be, a winner or a loser, and that's what happens. I mean, honestly, right now, that is the sort of feeling du jour.
I thought the conservative position was that, you don't get a participation trophy.
I think it's a generation thing.
Winners and losers.
I think it's
no?
generational.
It's generational.
I think so.
Now everyone's on board with this.
Yeah.
That's what's happening in the schoolyard. Everyone gets a medal, a certificate.
No, that was like 10 years ago.
Oprah Winfrey.
Yeah,
now I'm confused.
It's Oprah Winfrey schooling. You get a prize, you get a prize, you get a prize.
Decade old.
Up next on the program, a cloudy forecast for U.S. growth.
We don't really know where the economy is going to go. I was at 2, I moved to 1. Historically, when tariffs have played out, there's been a one-time jump in prices. For me, I think there is a question about whether that's going to happen this time.
That conversation up next with Claudio Irigoyen of Bank of America, live from New York City. You're watching Bloomberg TV.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because you know, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Equity futures on the S&P 500 just about unchanged this morning. A revision coming in from HSBC and Max Kettner. Now underweight the United States across the board. That applies to investment-grade credit, junk credit, and equities too. It's no longer about Goldilocks, Max says, but whether the sentiment shock will spill over into more U.S. hard data weakness. Refers to the uncertainty, says it's high, we all know that, but tariff noise is likely to extend beyond April 2nd, and that's the risk for this market. The next week is not the clearing event people want to see.
And how do you price something that could change from day to day and right now is having an effect on the soft data and may or may not have an effect on the hard data? That is going to be the ultimate debate over the next few weeks.
Under Savannah's this morning, a cloudy forecast for U.S. growth.
We don't really know where the economy is going to go. Business leaders don't know, families don't know, and local policymakers don't know either. I was at 2, I moved to 1. Historically, when tariffs have played out, there's been a one-time jump in prices. For me, I think there is a question about whether that's going to happen this time. We've just gone through a period of elevated inflation, so it is very much on the consumer's mind.
So here's the latest this morning. Federal Reserve Bank of Atlanta President Raphael Bostic tempering expectations as tariff hikes impede progress on disinflation. Bank of America cutting their growth outlook for the United States and the world, writing the growth revisions seek to capture the impact of the policy uncertainty shock on spending and capex in the coming months, as well as a more hawkish tariff stance. Claudio Irigoyen of Bank of America joins us now for more. Claudio, good to see you, sir.
Thank you.
First question, hardest question. How on earth do you put out a forecast in this environment? How difficult is that?
It's extremely difficult, but to be honest, sometimes uncertainty is worse than bad news because that impacts the decision of companies, irreversible decisions to invest or not. So the option value of waiting is higher when you don't know what's going to happen. And you can see the Fed. The Fed is exactly in the same position. They cannot move the needle until they figure out what's going to happen.
So with that in mind, how bad's Q1 going to be?
Actually, it's not going to be that bad. January data was bad. February data was much better. So probably January was a one-off. We marked to market the first quarter. We expect probably something between 1.5% and 2%. So the first half is going to be around 1.5%, 1.7%. And the second half is going to be around 2%, which is trend growth. It's not that bad, really.
At the same time, I think what a lot of people are worried about is that tariffs are going to keep the inflation picture a little bit stickier than otherwise was on track for. Atlanta Fed President Raphael Bostic yesterday, speaking with our own Michael McKee, saying that he moved to one rate cut projected for this year because he thinks that the path of disinflation is going to be very bumpy and not move dramatically and in a clear way to the 2% target. Do you agree that that now seems further out of reach?
Yeah, we had the view that inflation was sticky and was going to continue to remain sticky even before the tariff shock. And we expect PCE inflation around 3%, which is too high for the Fed to feel comfortable cutting rates with all that uncertainty that is basically upside risk to inflation. So we have the call that the Fed will remain on hold for the foreseeable future. And inflation will remain sticky, absolutely.
So it raises this question, when you talk about a growth slowdown, and Mohamed El-Arian was on this program and he asked this question, and I've given a lot of thought to it. Slowing to what? If it's not recession, if growth slows to a certain place, does it become really difficult for the United States to sustain the deficit that it has and continue with the growth that it has if you have inflation that is sticky? It's not stagflation, but it doesn't feel great.
It's a stagflationary flavor, let me put it that way. If you have the level of uncertainty that you have over the last 3 weeks for another 3 months, that will have a permanent effect on investment decisions and on consumption. So this administration can change the way it communicates to the market because the market has no political color. They just price what they see. And the correction in the market is the market telling we don't like these policies or we don't understand these policies. So at least communication could be more transparent for the market to understand that if this is a short-term pain for long-term gain, usually markets rally when the net present value of a project is positive. So communication is going to be key. And I noticed in the last 3-4 days that communication is more careful, at least.
Well, Trump has talked about being flexible, at least when it comes to tariffs. When it comes to your inflation forecast, it's very hawkish. Do you view some of this tariffs driven?
For you to have a sense, if you have an increase of 1% in effective tariffs, that gives you between 7, maybe 10 or more than 10 basis points increase in PCE. So tariffs, the 20% tariffs on China, that gives you 2.5 points of increase in effective tariffs. So that gives you already 20 points or so on PCE. And then if you do reciprocity, you can have another 0.5 point in increase in effective tariffs. So you can have a sense. The things get more hairy when you say, okay, I'm going to also take into account when I do reciprocity, VAT. Then it's a completely different discussion.
And digital services tax and currency exchanges, they're looking at everything across the board. That's what the executive order called for. What I'm hearing from you is it's not so much the tariffs, it's the uncertainty. Could we have an uncertainty-driven recession?
Well, you really have to keep this uncertainty level for a while. 3 weeks is enough for showing up in the soft data, as we were discussing before. Still, consumption data remains strong. Our credit card data shows that consumption is resilient. You had massive wealth effects over the last year and a half. consumers hedge their interest rate exposure big time. When interest rate collapse, they refinance their mortgages. So the balance sheet of the private sector is fine. The balance sheet of the public sector is not fine. And that remains to be seen how it's going to be addressed.
It's interesting listening to the administration in the last 24 hours when they talk about challenges to the economy. They kind of brush to aside the tariff story. They will accept, though, that DOGE and the rebalancing of the economy away from government spending towards the private sector could be damaging. And we heard that from Stephen Mirren, the chair of the Council of Economic Advisors, just yesterday speaking to Bloomberg News. I don't think there's going to be a material short-term pain from the tariffs. I think the short-term pain is coming from the reorientation of the economy from the government to the private sector. How do you and the team think about DOGE and what it could do to your outlook?
I think it's too early to tell. There are a lot of things that the administration said we're going to do it, and it's not easy to implement. The execution risks are still high. But DOGE is another example in which uncertainty is not enough to characterize this economy. You have to add to the uncertainty confusion. So we can agree that tariffs will be 2%, 10%, 20% higher or not on April 2nd. We can agree on the probability distribution of that random event. But we can disagree, and people disagree a lot on the effect of that on the economy.
When it comes to DOGE, is your concern in the effect of the economy on the labor market and potentially the business contracts that you have the private sector doing with the U.S. government?
It's still, when you quantify it, it's still relatively minor and very concentrated on some geographical areas, the DC, etc. But it's going to impact on sentiment, right? So it creates uncertainty of where we are going. So if you have a master plan that has different pillars, energy, immigration, fiscal consolidation, tariffs, you got to put it together and explain to the market, this is what we have in mind. If you do it piecemeal, you create confusion.
Well, they have a master plan, but they're doing it piecemeal in the sense that they're addressing tariffs first. By the end of the year, they want an extension of TCJA, and they want deregulation along the way. If you take the Trump administration's economic policy together, do you think it's a fair outcome?
What we have in our forecast is an economy that eventually will continue running around potential. I think policies can have the right, the idea could be great, but implementation risks are very high. If you impose tariffs in the morning and remove it in the afternoon, even if you end up with 10%, 20% tariffs at the end, that transition doesn't help.
It's difficult to plan with that backdrop, that's for sure.
Absolutely.
Claudio, it's good to see you. It's good to catch up and get your thoughts from the team over at Bank of America. Claudio Irigoyen there. The detox this administration is talking about, what they consistently reflect on, refer to, is government spending. It's not about the tariffs. It's about moving away and weaning this economy off government spending, which has produced some tremendous results in this economy just in terms of headline growth. We've been talking about 3% GDP growth for the last 12 months or so. We've been running a deficit north of 6% with unemployment at 4%. It doesn't really make sense that we've been doing that for the extent that we have done.
And a lot of people would agree with that you need to rectify that situation at a time where what Stephen Mirren was saying was that 3/4 of the growth and the employment was somehow tied to some of this government spending. At this point, the question is the implementation risk, just as Claudio was saying, and just how strategic some of these plans actually are in achieving the ultimate goal, which is reducing that deficit.
You don't want to pay for this with a recession. Secretary Besson, I think, was pretty clear in that in some of the conversations we've heard from him, particularly over the last week. Equities at the moment on the S&P 500, just about positive. Coming up next on the programme, we'll be catching up with Cameron Dawson of New Edge Wealth, Libby Cantrell of PIMCO, Tom Naran of RBC, Sonal Desai of Franklin Templeton. From New York City, this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Humility is clearly a term that should be utilized now.
None of us actually know exactly what's going to happen.
We are at an unprecedented level of uncertainty. The commentary on the outlook is as wide as I've never seen it.
I would put a much higher probability that we don't have clarity after April 2nd.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now on a two-day winning streak on the S&P 500 and looking to add just a little bit of weight to that rally. Equities up on the S&P marginally by not even 0.1%. On the Nasdaq 100 this morning, just about unchanged. The next stop for this market, plenty of data through the week, but look out for this one. In 3 hours' time, at 10 a.m. Eastern Time, U.S. consumer confidence data. Another read on how the consumer feels about the tariff volatility.
The soft data taking an increasing amount of importance. It is the fastest moving data point that people are clinging to understand what the uncertainty that we talk about every single day ad nauseum is really doing to consumer confidence. I do wonder how much people trade on this, because we have seen time and time again that it hasn't filtered into hard data. We were just speaking with Claudio of Bank of America, who said it usually takes 3 months before it really starts trickling into that hard data.
And the tariff proposals seem to change from day to day, hour to hour. The President of the United States yesterday teasing a lighter touch on tariffs and setting up some negotiations down in Washington, D.C. Later on today, a meeting between the top trade chief out of Europe alongside the Commerce Secretary, Howard Lutnick.
There's a rush from all these trading partners to want to get a deal before April 2nd. But I think what you see from President Trump in his latest comments and the rhetoric is that he's willing to be flexible. This quote: "They've charged us so much that I'm embarrassed to charge them what they've charged us." It'll be substantial, and you'll hear about it on April 2nd. But you see there is movement potentially for this negotiation to take place, and he seems to be in deal-making mode.
So what are businesses doing? They're waiting. The Federal Reserve is as well. I would look out for those comments coming from the New York Fed President John Williams just a little bit later on today, as they have to confront real risk. Apollo's Torsten Slog this morning calling those risks stagflation risks, and those risks are rising.
Yeah, and that seems to be what was reflected in the Statement of Economic Projections, which we saw, and frankly, what was reflected by Atlanta Fed Chair Raphael Bostic speaking to our own Mike McKee, saying that essentially inflation is going to have a harder path down to 2% than it otherwise would have, even though growth is decelerating. Again, are they hawkish? Are they dovish? You can keep debating that because it's not going to be resolved.
We found out where his dot was, though.
Yeah, one.
He's come down from 2 cuts for 2025 to 1, and he's not alone.
There are 8 other people who have done the same thing, which is a reason why there was a sense that maybe this is hawkish. At the same time, how high is that barrier to understand slower growth? And what are they looking at? It puts the emphasis on core PCE, which we're going to be getting on Friday.
Lots of data through the week, including consumer confidence later on this morning at 10 a.m. Eastern Time. Equity futures going into that just about positive by 0.1%. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth as investors exhale. Libby Cantrell of PIMCO as global trade partners race to make deals in Washington. And Tom DeRyan of RBC as Tesla sees continued weakness out of Europe. We begin this hour with stocks steady after notching one of the best days of the year so far. Cameron Dawson of New Edge Wealth writing, our key message to clients is get comfortable being uncomfortable. We see volatility continuing even as we bounce off of oversold, low sentiment levels. Cameron joins us now for more. Cam, it's good to see you.
Good to see you.
Let's talk about your conversations with those clients.
Yeah.
What are they telling you? Are they freaking out? Are they bearish? What's the response?
Clients are still very calm, and we think it's because if you look at a 70-30 portfolio of ACWI versus the ag, you're still up about 1% for the year. So yes, we have seen this weakness within U.S. equities, but if you are a diversified investor for the first time in a while, you actually feel good about having non-U.S. exposure, which has helped to dull some of the pain that you have seen within the concentrated U.S. markets.
How far out are they willing to extrapolate that recent underperformance, US versus Europe? Are they starting to wonder whether this could be a multi-year game or is it a short-term game?
We're certainly asking that question, meaning are we going to see a repeat of the 2000 to 2007 period where it truly was a multi-year period of non-U.S. underperformance versus the rest of the world? We think it really depends on 2 key factors. You have to see continued dollar weakness. You have to see much further downside in the dollar to suggest that capital will leave the U.S. and go to the rest of the world. And you have to see it backed up by earnings. So if you look year to date, all of the outperformance of Europe has been driven by valuation expansion. It's gone from 13.5 times to 15 times. Earnings estimates have actually gotten cut. So if you think that this is going to last more than just a couple of months or a couple of quarters, you have to believe in the earnings story.
So how do you understand that multiple shift? How do you understand the idea that we've seen a weakening in the dollar and a sell-off in the S&P 500 for one of the longest periods that we have in the past few decades? If it isn't necessarily some fundamental shift, what is it?
We have to appreciate that we went into this year with a massive record dollar long position. If you looked at futures trading, you had a huge position where everybody was long to their eyeballs the dollar. That has now reversed, and you actually see traders being slightly short the dollar. So we think that the dollar could actually find some stability here. Maybe in the short term, you see some mean reversion in some of those trades. The last 2 days, Europe has been underperforming the US. So it's very alluring to try to ascribe a narrative to price action, to say, end of US exceptionalism, the US exceptionalism story is over. We think it's actually a lot more about dollar positioning, at least in the short term.
Yeah, you said this question in your notes, which I thought was great. Is it the end of US exceptionalism or just a positioning unwind? Seems like maybe it's a little bit of the latter. I am curious what this means going forward then. If this gives the sense that not only will there be stability to the dollar, but also say to the Magnificent Seven, which have unwound at a disproportional pace.
Well, and we do think the weakness of the Mag 7 was a function of its strength at the end of the year. Mag 7 outperformed so much in December that was not justified by the fundamentals. Earnings estimates were getting cut. It was all valuations. So this is all just these positioning shifts moving around. We've now gotten to the point where positioning is a bit more balanced. You've gone from the 98th percentile in U.S. positioning to the 26th percentile. That does set you up for a little bit of a relief rally. The question is, Europe is still trading at 15 times versus the U.S. at 20 times. What's the driver to potentially see those multiples converge further?
You know, you said get used to being uncomfortable. There are a lot of people who say, I don't want to be uncomfortable. I want to have some sort of forward indicator to get an edge at a time where it seems like there's a lot of noise and nothing else. What are you looking for to change materially, to get some conviction one way or another?
We have to start from the basis that indicator economics and what used to work in prior cycles does not work in the post-COVID world, which means that we can't look to things like the 10-2 curve of telling us if we're having a recession. We can't look at those sentiment indicators because they've been so misleading. One of the things over the last 2 years that we've been saying is that watch what they do, not what they say, meaning that you cannot look at sentiment and soft data and extrapolate it into hard data. We think it's actually more important to look at what the equity market is saying about the consumer, for example. So look at equal weight discretionary versus staples. If discretionary is underperforming staples, the equity market is sniffing out that there's trouble in River City with the consumer. If it continues to be in an uptrend, then the equity market is telling you a message of it's okay.
Watch what they do, not what they say. Are you also using that same logic when it comes to policymakers in Washington?
Not necessarily. There has been follow through in what they've been saying, and I think that that was one of the follies going into this year, thinking that it was all just rhetoric coming out of DC and that we wouldn't see policy follow through. But we certainly are seeing it, at least to an extent. Yes, we have the flip flop and the ping pong about how much we're actually going to see tariffs enacted, but there are real policies being enacted, which is weighing on activity that we see today.
April 2nd is increasingly difficult to understand. The Financial Times just put out this report that the president is considering a two-step tariff regime on April 2nd, according to people familiar with the matter. Among proposals, and I'm citing this story directly now, his team has been discussing is a plan to launch so-called Section 301 investigations into trading partners, so that's unfair trading practices, while simultaneously using rarely invoked emergency powers to apply immediate tariffs in the interim. So you could see a couple of phases of this, which is a reason why the people like Max Kettner of HSBC are worried that this uncertainty will linger beyond April 2nd. And Anne-Marie, this is something you've talked about repeatedly. There are things you can do on day one on April 2nd. There are other things you'll have to wait to execute on.
Right. If you want to use Section 338 or IEEPA, you can maybe use national security lever, and you can have a tariff that day in an executive order. If you want to look at something that is more long-term, if you need public feedback, then you would take weeks or months. But what the Financial Times is saying, and it's something I think makes sense for how Trump likes to enact policy, you might see both on that day. Come out with something really sharp because he wants to deliver, but then at the same time, it's a little bit more nuanced when it comes to maybe specific countries or sectors.
Cameron, this makes April 2nd really tough because is it going to be a clearing event? Maximum uncertainty, move beyond it, move on by stocks, or will it just get more confusing?
I think that Peter Cheer earlier this week was really wise in saying that if we get clarity, is that actually a bad thing, in the sense that the current EPS estimates do not contemplate the kind of tariff regime that's even the tariff light that is being presented, which means that we do think that there is downside to earnings estimates if we get the clarity that people can actually start putting it into numbers. We see this arrested development in decision making. It's the, if you choose not to decide, you are still making a choice. Businesses are sitting on their hands and not making decisions, and that could result, we think, in lower earnings estimates, which we think challenges the valuations of equities even further.
Bad thing for who? And bad for which equities? The United States or the outperformance we've seen in Europe and elsewhere in China?
I don't think that the European rally has been pricing in the risk of tariffs being escalated, which just means that you're seeing all of this strength in re-rating, which is more of a positioning flip than necessarily thinking that Europe is going to do better because of the tariffs. So if we actually see them enacted, we think it's more of money leaving global equities versus shifting from one place to another.
I'm with you. I love the piece from Pete over the weekend. Careful what you wish for. If you get the clarity, you get the certainty. Is that when we start to fully appreciate the kind of damage it could do to the economy? And I'm not talking about the United States. I'm talking about the rest of the world.
Which is something that people were pricing in at the end of last year, and everybody seemed to ignore because they were all benumbed by the idea of Germans spending money, and that seemed to take everyone's idea of what tariffs would do to the rest of the world out of the minds.
Cameron, good to see you, as always. Great to catch up. Cameron Dawson there of New Edge Wealth. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. U.S. and Russian officials met in Saudi Arabia a day after American and Ukrainian teams held talks. The discussions focused on the safety of navigation in the Black Sea and a potential maritime ceasefire. The ultimate goal, though, achieve a broader and permanent peace. Ukraine's ambassador said that they support the U.S. push for a full 30-day ceasefire. Boeing reportedly wants to withdraw from a plea deal with U.S. prosecutors. It previously agreed to plead guilty to misleading regulators before 2 deadly 737 MAX crashes. The Wall Street Journal now reporting that Boeing is seeking leniency from the Trump administration, which is reviewing pending white-collar criminal cases. Elsewhere, Google's Waymo plans to expand robo-taxi services to Washington, D.C. next year. The move would give U.S. lawmakers and officials more exposure to self-driving cars as they develop federal testing standards. Waymo said that it still needs to work with the D.C. government for permission to operate without a human driver. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on this hour. Up next on the program, counting down to Liberation Day.
They've charged us so much that I'm embarrassed to charge them what they've charged us, but it'll be substantial, and you'll be hearing about that on April 2nd, and it will be Liberation Day.
Up next on the program, Libby Cantrell of PIMCO, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Equities on the S&P 500 just about positive by not even 0.1%. Just two things to look for throughout the day, two of many, but these are the ones that I would focus on. Consumer confidence coming later this morning at 10 a.m. Eastern time, and then you will get some Fed speak. Look out for the New York Fed President, John Williams, speaking later on this morning. Under surveillance this morning, we're counting down to Liberation Day.
We may take less than what they're charging because they've charged us so much, I don't think they could take it. In other words, they've charged us so much that I'm embarrassed to charge them what they've charged us, but it'll be substantial, and you'll be hearing about that on April 2nd. And it will be Liberation Day because we'll be taking in large amounts of money for our country.
So here's the latest this morning. Officials from the European Union and India rushing to offer concessions to the United States ahead of the April 2nd reciprocal tariff deadline, as President Trump signals some countries will get breaks. Joining us now is Bloomberg's Tyler Kendall. Tyler, which countries will get breaks? I think that's the most important question going into next week.
Yeah, well, John, that remains to be seen. Our Bloomberg News reporting indicating that President Trump is taking into account whether or not countries have been cooperative or combative when it comes to these talks. Of course, some prime candidates, of course, would be those countries that have no tariff barriers, low tariff barriers, or run a trade surplus with the U.S. Now, you mentioned there those high-stake talks with the EU's trade chief today here in Washington, and we have to keep in mind that when it comes to the EU in particular, they have faced some pretty tough rhetoric from President Trump. We're talking a lot about concessions. For example, we know that this White House would like to see the European Union drop its tariffs when it comes to American auto imports into the EU, but we also have to keep in mind that these discussions are revolving around those non-tariff barriers too, including value-added taxes and digital service taxes, which would be considered a pretty lofty goal for this administration. I was there last week when NEC Director Kevin Hassett was asked if this White House is really looking for European countries to dismantle their entire tax systems, and his response was that this White House would be, quote, sensible in regards to that. Another ongoing negotiation we know about today, an American delegation touching down in India. I will say that President Trump has often labeled India a, quote, tariff king. It does appear that they are starting to peel back some of their tariffs, but that President Trump doesn't seem rather optimistic that they are going to be lowered when it comes to India. However, John, it is prompting some economists to be potentially optimistic that the country could be reversing some of its long-held protectionist policies.
So meetings with the Europeans, meetings with India, as well as a call with the Chinese. Tyler, are we going to have any certainty on April 2nd, though?
That is one of the biggest questions that remains to be seen. At this point, there are a lot of different things up in the air. Potentially, we could hear some of these countries coming forward with those tangible concessions that this administration is looking for. Particularly, we know that there's being progress made, even if it's slowly, when it comes to China. We had Senator Steve Daines, a Republican from Montana, coming back from over the weekend from Beijing. Now we have this next step when it comes to the USTR's call. But it really does remain to be seen, particularly as we look ahead, that April 2nd, as of now, will not be paired with those sector-specific tariffs, but that those also could be coming. President Trump previewing auto tariffs could be here any day now.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. To extend the conversation, joining us around a table here in New York, Libby Cantrell of PIMCO. Libby, good to see you.
Good to see you.
Attempting to read the tea leaves in Washington is a dangerous game, but we're going to play it just quickly. Do you think maybe based on the comments of the last 24 hours, the President and this White House are realizing some of the legal constraints around what they can and can't do on April 2nd?
Yeah, and what we know about his trade advisors, Jameson Greer in particular, who's his U.S. trade representative, he is particularly focused on the legality and the durability of these tariff actions. I mean, remember that April 2nd was sort of the date that was set out in the executive order in the first week of the administration that really was supposed to clarify kind of the trade agenda. It was before the Canada-Mexico tariffs, before the Colombia threats, before the aluminum and steel tariffs. So I think in some ways this should, provide some coherence in terms of the trade agenda. But again, the legality, I think, is very crucial here. One thing that we were talking to clients about is this just an announcement of future tariffs? Is this sort of forward guidance, if you will, for tariffs? Or is this actually an announcement that tariffs are rolling on April 2nd? And I think that actually has to interplay with the legality. If this is being used under IEEPA, then he can do this day one. If this is more of a broader investigation, then that will take several months.
Well, the FT is saying it's both. There's going to be two tiers. Potentially we get some tariffs day one, and then longer term they're going to look into some trade imbalances. I love that you talk about mind-numbing process, because I actually think it's important whether or not they use IEEPA, whether or not they use 338. Can you walk us through what they potentially have a menu of to enact on April 2nd?
Yeah, and as we've discussed before, the executive branch just has wide discretion in terms of what they can do on tariffs unilaterally. So, of course, they don't need to go through Congress for any of these things. These are authorities that they already have. But they do depend in terms of timing. So Section 301, for instance, that's an investigation that usually looks into a specific country's practices. That investigation can take months. This is the authority that the Trump 1.0 put tariffs on China. So if it's an announcement of a 301 investigation, then again, you're kind of giving the market some forward guidance about what to expect. if they use IEEPA, if they use Section 338 of the Tariff Act from 1930, then
it's huge. It's up to 50%.
Then those can go on day one. So I think this is where Jamieson Greer, though, who is a trade attorney by background, again, U.S. trade representative, I think is going to be very focused on the legality of all of this, the durability, and the fact that he doesn't want to be fighting this in courts, right? He wants this to stay. This is supposed to be part of a broader kind of either national security and economic agenda, and again, he's going to be focused on.
So you're outlining how they may be able to get there legally. What countries do you think they're going to go after?
Yeah, I mean, if you just look at the trade deficit, and you know, this president, people may agree with him or may disagree with him, but he's been incredibly consistent about his focus on the goods trade deficit in particular. And if you look at those countries with the biggest goods trade deficit, it's China, it's the European Union, it's Mexico, and it is Canada. And then he's also going to be looking at the tariff rates. And this is where I think it does get a little bit complicated. I think that reciprocity, broadly in terms of the administration, they agree on this idea of reciprocal tariffs. But how do you calculate that tariff? Does that include things like the value-added tax in Europe? In which case, that reciprocal tariff that we would impose on Europe would be much higher than what the stated tariff level is. So I think there are obviously a lot of open questions about what this actually means. But I do think we will get some clarity next Wednesday. I think the big question is, does the market like that clarity?
Well, the market seems to like the lack of clarity, or just tea leaves that they've been getting over the past couple of days. Have we gotten any further clarity or any more of a sense of what the framework looks like over the different speeches that we've heard over the past few days, kind of in tandem with what the market's sniffing out?
Yeah, and again, is this intentional, kind of a softening, a walking away from some maybe the more draconian measures, or is this maybe just a byproduct of the fact that this was supposed to be really the big reveal, if you will, of the sort of the administration's trade policy, and it wasn't supposed to be necessarily sort of so draconian, I don't think. I think it was supposed to be part of a broader economic strategy. And so I think some of that is we're just sort of seeing that kind of fleshed out.
How much do you think the sequencing of this matters, where they want to get this out of the way and then pencil in certain revenues from these tariff plans to then bring to the tax discussion that is very much going to come to the fore in the remaining months of the year?
I mean, we've been using this framework with our clients, the vegetables and the dessert. And we knew that the Trump...
I take issue with that. Vegetables are good, but sorry.
Wait, it sort of depends on what you're... Steamed vegetables and dessert and ice cream sundaes. How about that?
Thank you. That's perfect.
But we've had a lot of steamed vegetables, right, without salt. And we have not had a lot of the ice cream sundaes. And so I do think this was sort of what we expected, that there was going to be this kind of push and pull in terms of economic policy. But in terms of the market, they've had to stomach much more vegetables than dessert, to belabor the metaphor. So I do think there's going to be a quick pivot to what are the things that they can do from a growth agenda perspective. And then I think the big question, I think, for the markets and for bondholders is, what is the deficit impact? Because I'm skeptical that a lot of these sort of spending cuts that have been penciled into the kind of framework that is being proposed in the House in particular will actually be enacted into law. I think those things are very difficult, easier said to do than actually to do.
You've got Doge doubts. What happens with Doge?
I do have Doge doubts. Now, this is an active discussion within the walls of PIMCO, so this is more my personal view. Sure. But if you actually look at, and this is, again, mind-numbing process, but actually quite important, anything that is that Congress has already appropriated, spending that they've already appropriated, that gets then kind of cut or pared back by Doge, that does not go to the Treasury General account. That does not go to pay off the deficit. That by law goes with basically a checking account within that agency and has to sit there for 5 years. This I don't think necessarily the market understands. That means that, again, these make good sort of sexy headlines, if you will, but in terms of actual deficit reduction, we definitely haven't seen that yet, and you have to get that enacted by Congress and codified into law.
Libby, it's good to see you. As always, great to catch up. Libby Cantrell there of PIMCO, breaking things down on both the trade front and the tax front. The tax story is going to be tough. It's going to be really, really tough, because just extending tax cuts, just from a political perspective, going to the midterms next year and campaign on the counterfactual, well, we got this done and it could have been so much worse if we didn't. That doesn't work. What are the additional tax cuts you're going to offer people? What's that going to look like in 12 months' time?
You got to have a sprinkle on that Sunday in order for this to really nail a punch when it comes to the midterms, and also Trump basically pledging on the campaign trail that he would deliver more, whether or not it's no tax on Social Security, no tax on tips. Getting that through Congress, incredibly challenging because of how slim the majority is in the House.
To take it a step further, it's not just that you can't show people that much of a difference. It's that in order to pay for the extension of those cuts, you're going to need to really considering cutting Social Security and Medicaid.
There's a lot going on, but it's a little bit snoozy out there this morning. That's a good thing. Equity's just about unchanged on the S&P 500. Lots going on for Tesla as well. Tons of drama in the last month or so. Tom Narayan of RBC joins us next as Tesla sees continued weakness out of Europe.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Equities just a touch firmer on the S&P 500, higher by close to 0.1%. Just a programming note, Max Kettner, HSBC, underweight the US across the board now. IG credit, high yield credit, equities too. Max joins us tomorrow, 6:30 Eastern time on Bloomberg TV, right here on Bloomberg Surveillance. Do not miss that tomorrow morning. With 2 hours until the cash open here stateside, let's get you your morning calls with Danny Berger. Hey, Danny.
Hey, John, maybe another reason to be bearish. KB Homes out warning of pain with the consumer. They had earnings. If this share fall sticks into the open, it would be their worst day since 2020, a decline of more than 8.5%. They cut their view for the full year, saying that the consumer has an affordability issue, and that uncertainty, that's the word they used, over both macro and geopolitics means that they are delaying big home purchases. Now, to the upside this morning in the pre-market, we have Trump Media, DJT, that's up 8%. They've signed a deal with Crypto.com. Crypto.com will now sell them ETFs, which they say are tied to digital assets and U.S.-focused investments, calling it an America First type ETF. Those will be on sale this year, pending regulatory approval. Rounding things out with BABA. Look, Chinese tech stocks had a really difficult run today. They are nearing a correction after their spectacular rise. Alibaba, though, particularly in interest, down nearly 2%, with the chairman warning that there might be a bubble forming in data centers, that there is more being built than there is demand for. John, it has serious consequences for the hyperscalers and the investment infrastructure funds that have been plowing money into data centers.
A bubble warning from Baba. It's quite a story. Danny, appreciate the update. Thank you. And I'm pleased you went to KB Homes as well. It's not just the survey data. You're seeing it from the earnings. You're seeing it from the companies. It started with Delta Airlines. You said in the middle of February, things started to stall out. KB Homes, a miss on the top and bottom line for the first quarter, and Lisa, a cut to the outlook.
This has been one of Neil Dutta's points, that if you take a look at the home builders, they usually lead on the way up and they usually lead on the way down, and they've been performing really badly. They're getting hit on a whole host of different levels: affordability, costs of labor, and also this uncertainty of the interest rate outlook.
So what does it mean for the Federal Reserve and interest rates? On our radar this morning, Atlanta Fed President Raphael Bostic seeing just one rate cut on the table this year as a result of tariffs. We get more Fed speak through the week. You'll hear from Kugler and Williams today, followed by Kashkari and Muslim tomorrow.
Michael McKee asked Raphael Bostic about the word transitory and whether he would agree with Jerome Powell. He said, "I am not going to say that word, nope." And this to me was really interesting. Does Jay Powell represent the mainstream of the Federal Reserve when talking about the likelihood that the tariff effects would be transitory and that some of the increase in inflation that they could see later this year truly is something that they could look through and focus instead on the weakness? That was not the view of Raphael Bostic.
Depends who you define as the mainstream of the Federal Reserve. Do I think there's some daylight between him and a lot of officials? Absolutely. And you saw it in the forecast, which was what was kind of odd about that meeting last week. If you looked at the dot plot, the distribution of the dots for interest rates this year, that skewed really hawkishly. There were some committee members that said, you know what, I thought 2, now I'm thinking 1. And it wasn't just Raphael Bostic, it was others too, as they were looking out 12 months or so. Are we thinking of Governor Waller? Is he on board with Chairman Powell? Probably, based on what he said on tariffs in the last few months. Are we thinking of New York Fed President John Williams? Most likely. He's going to speak later. I imagine he will echo the sentiment that came from the chairman. But I'm with you. There are other people on the committee where there's some real daylight between that performance in the news conference with him and what they're seeing elsewhere.
And the reason why that's important is because to understand the reaction function of the Federal Reserve, it is important to understand where the gravitational force is. It has been with Fed Chair Jay Powell. At this point, it's going to be really important to listen to all the different Fed officials to understand whether there is enough of a mainstream on the other side to push back against that kind of view.
Understanding tariffs and what it means for this economy is going to get harder potentially. Take a listen to this. President Donald Trump threatening so-called secondary tariffs of 25% on countries that buy oil from Venezuela, saying in a Truth Social post and an executive order that Venezuela has been hostile towards the United States.
What I find interesting about this is it's been written in a way that gives the State Department flexibility in determining who is going to get hit with that extra 25%. Basically, China will be the one, but maybe not other countries that might have to buy some Venezuela crude. The bigger issue, though, is how do you actually track this? Say you're a vessel that is carrying Venezuelan crude. Can't you just maybe sell it to a Russian vessel in the middle of the sea, and then Russia can sell it to China? The problem is, how do you enforce this? It's been a huge problem when it comes to Iranian oil, which is why Iran has been able to sell 1.5 million barrels a day to China. The tariff could be there, like the sanction could be there, but you have to enforce it.
With great difficulty is the answer. I had a message from a Bloomberg subscriber just moments ago on this topic, said this: someone should ask why the United States consumer has to pay a higher consumption tax because China is importing oil from Venezuela.
Okay, I'd like to hear the answer to that. It seems like sanctioned is a dirty word and tariff is a beautiful word that is going to be deployed in all sorts of different ways. Whether it's used to the same end and whether it can be used to the same end remains to be seen.
Need to talk about the autos too. Tesla's European sales falling in 10 of the last 12 months. The EV maker seeing a 43% decline in the first 2 months of the year, deviating from the 31% rise in industry-wide EV registrations. To discuss, Tom Naran of RBC joins us now for more. Tom, we've talked about this with you before. Does this data point matter or not? Does it matter to you?
Yeah, I mean, any data point matters. I love data. I'm an analyst. But what I would say is what I've said before, right? We have to put everything in context. There are an affordable car that's coming. There is the Model Y refresh. There's definitely potential that this Osborne effect is taking place. Consumers waiting for these new vehicles to come. Also, January and February aren't exactly the most, thrilling months to extrapolate data from. And they had the intentional shutdowns, right? And look, we're talking about a few thousands of cars. We focus too much on the growth rate, as we've talked about before, in the context of 1.7 million cars sold last year, being down by a few thousand. I understand the market was up, but I do think we need to take everything, look at the big picture here. Let's see what March does. Let's see what April does, what these new vehicles do before we start getting, overly excited about this data.
Tom, you know the story. It's reinforcing pre-existing concerns before we even got this data, concerns about a potential for a consumer boycott. This is where that particular subject gets a little bit more complicated. If you look at how Doge polls in the United States, Doge polls really quite well based on some of the reviews and surveys that I've seen in the United States. Where do you think this is breaking down? Is there a real potential for people to turn around and say, I don't like the work Elon Musk is doing in the government, I'm not going to buy a Tesla? Is that actually what's happening?
Well, I mean, again, I'm an autos analyst. I can only tell you what I'm hearing from investors on the subject. And what I've been hearing is, a car purchase is very different than, let's say, boycotting a can of soda was the example I was given. People are going to buy what's best for their families. In the U.S., Tesla's half of the entire EV market. If you're taking the plunge and buying an EV, will you buy this product, which for all intents and purposes is a good product, or will you buy a product from a different brand? The switching costs are very difficult there. But again, I'm just an autos analyst, not a political scientist. I'm just looking at the data right now, and at this point, we need to see how these new vehicles fare in terms of demand.
Tom, moving away from the political sphere, there's a question about how much some of the question marks around Elon Musk have really encouraged competition to ramp up, particularly overseas, and maybe have more inroads, at least with consumers in the short term. And I'm wondering not just about BYD, but I'm also wondering about European models like Citroën or Stellantis or Renault that come out with these cheaper models to try to compete with their Chinese brethren that are coming with autos to sell in the European Union. Does that pose a threat to Tesla longer term, that there is this kick-starting in the competitive angle?
Yeah, but I'm not sure anything has really changed. I mean, Europe is definitely the kind of third engine, right, for Tesla, right? The focus is really China and the U.S. I'm actually really more worried about what's happening in China with competition there. Sure, Europe is very competitive, but remember, Europe is like 2x the EV penetration as the U.S. So it's a great market for Tesla to penetrate, and they have very low penetration right now. They have the plant in Berlin, which is ramping up production and producing there. Certainly, it's a very competitive market with Chinese coming in, et cetera. But yeah, it is important, but it is the third engine there for Tesla. I'm more focused, my concern is more on the domestic Chinese market for Tesla. But again, we need to see how these new models fare, the new Model Y refresh, and of course this affordable car, which with the IRA credit in the U.S., remember that's still their most important market. You can get it for $30,000. We have to see how consumers react to these.
How much have investors been pushing back against your buy thesis on Tesla at a time where there has been so much discussion about this name? And I'm talking about the past few weeks.
Yeah, I've done a ton of discussions with investors. I'll be honest with you, the big topic is really tariffs. But yeah, I mean, Tesla definitely comes up. I think a lot of folks are looking at the stock tactically. Typically, they're looking at how far the stock had pulled back, and they're trying to understand if now is a good entry point. Some people are doing real fundamental work on the name, and I'm happy to provide my robotaxi analysis, which I've spent a lot of time and work on, and pleasantly surprised that people are doing their homework. I think that part of that is because the stocks pull back, and they realize, look, car sales definitely catches a lot of headlines, but at the end of the day, we think this is an autonomy company. So we love the fact that they're doing their work on what's happening not in 1Q24, but in the year 2035, the year 2040, and we're really happy that some investors are looking at that perspective as well.
But Tom, in the short term, there was a recent poll the last few days out of Germany. 94% of respondents of 100,000 Germans said they will no longer buy a Tesla. And obviously, Germany is where we see this rejection, really, when it comes to some of the sales of these cars. I know you're thinking long term, but how concerned are you that this brand reaction to Musk could be pervasive?
Yeah, and I didn't conduct that poll. I did see some pushback on that poll in the press in terms of who the respondents were, but again, I'm not part of that poll. But again, I think at the end of the day, we need to see how these new vehicles fare. Europe is very underpenetrated for Tesla. They're still growing there. It needs to electrify because of CO2 compliance in Europe. Tesla provides a compelling product. So do other European OEMs. So we just have to see. I think, obviously, there's a lot of stuff in the press. But at the end of the day, people are going to buy the best product for their families when it comes to a big-ticket item like a car.
Let's get to tariffs, because you say that's what everyone in the industry is talking about. And that's what we're talking about as well. Besides April 2nd, Trump laid out somewhat of a timeline for sectoral tariffs, and he characterized auto tariffs as coming, quote, in the next few days. Tom, what do you make of all of this?
Yeah, I think we saw a similar playbook back in the first Trump administration, right? Because, if you think about it, if there is a decision on April 2 and it is severe, it will have a dramatic impact, right, on this industry. And so, what happened before was you did have some information, some decisions actually even happened before the tariff war is supposed to take place. So it does make sense that we could have some clarity before that happens. I will say that from these investor meetings, we've had quite a few in the past couple of weeks, there is a consensus, and we heard obviously from what was reported over the weekend, that perhaps Canada and Mexico tariffs could be averted thanks to USMCA and how the U.S. auto industry is largely compliant there. And there is this consensus brewing about reciprocal tariffs that they perhaps could be implemented, although some pushback from some folks saying it's unclear how they would necessarily help the U.S. auto industry. And as we saw from the first Trump administration, neither actually were ever implemented.
Stock is up this morning by 1.4%. I think we're up about 25% since Governor Walz downgraded the stock. Tom, it's good to see you. Tom Naran there of RBC. Did you watch that rally? Governor Walz, Minnesota?
No, I did not
Had his phone up, looked at the stock, and okay, move on. All right, let's give an update on stories elsewhere this morning. Someone got that joke. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The FT reporting that President Trump is considering a two-step approach to his new tariff regime on April 2nd. The report cited people familiar with the discussion, saying Trump's team is weighing proposals that would give a legal framework to reciprocal tariffs. It would also act as a tool to apply up to 50% tariffs on trading partners. Private text between Vice President J.D. Vance and Defense Secretary Pete Hegseth said European allies are freeloading off of U.S. efforts in Yemen. That back and forth was revealed after The Atlantic's top editor was accidentally added to the group chat. The messages also suggested that the cost of the Houthi strikes be levied on the Europeans. Millions of Americans who sent their saliva to 23andMe may now see their genetic information sold to the highest bidder as part of its bankruptcy filing. The company proposed an auction for the sale of its assets in May, sparking privacy concerns. 23andMe said that customers can delete their genetic information off of their accounts. And that's your brief, John.
Some scary stuff right there, Danny. Thank you very much. More from Danny later on in the next hour. Up next on the program, Trump calls for a rate cut.
I'd like to see the Fed lower interest rates. That's just my opinion, because things are coming down. We have inflation under control. Tremendous amounts of money will be soon coming in from tariffs.
Up next on the program, Son of Desire, Franklin Templeton, live from New York City. This is Bloomberg.
About artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Stocks about in here on the S&P 500 up by 0.2%, looking to build on 2 days of gains on the S&P 500. Mentioned Max Kentner of HSBC a few times already this morning, downgrading US equities. There is a constructive view out there, though. Evercore's Julian Emanuel saying the bull still lives as the tariff liberation day approaches. JP Morgan's Dubravko Lakos-Buja saying the risk of another violent unwind should be low in the short term. We add to some of the recent relief. The Nasdaq is higher by 0.1%. Under surveillance this morning, Trump calls for a rate cut.
I'd like to see the Fed lower interest rates. That's just my opinion, because things are coming down. We have inflation under control. Tremendous amounts of money will be soon coming in from tariffs, which is about time that we were able to partake. We've been ripped off by every country on that basis.
So here's the latest this morning. President Trump reiterating his call for the Federal Reserve to cut interest rates. Son of Desire Franklin Templeton sticking with her call for at most one rate cut this year, writing, while tariffs and immigration have come up front, concrete action on deregulation and tax policy is expected to follow, and these are the two elements that should help tilt growth and contain inflation. Sonal joins us now for more. Sonal, good to see you. That's a more constructive view on US growth. A lift to growth at the end of the year, potentially.
Well, I don't know whether we wait until the end of the year, but a slightly more constructive view than perhaps some in the market have taken. At the end of the day, we've had a couple of months of definitely freezing up as everyone, looks at the sequencing being exactly the opposite of what they would have liked to have seen, which was the nice stuff first, and we didn't get it. And we all expected it, and instead we got the complications, the uncertainty, the changes by the Fridays to the Mondays on what policy would be, which gives very little visibility, and markets don't like that.
And yet, even with that, bond yields are north of 4% across the curve.
Yes.
So where will they be as we work our way through the rest of 2025?
So I'm not actually changing my call for fair value on the 10-year to be between 4.75 and 5 here. And that is because I would anticipate that we aren't actually at the point of an actual recession. We're seeing a freezing up of growth, and then there's likely to be a catch-up if we actually see the tax cuts and deregulations which were promised to us, because those are growth positive. Now, we can discuss the long-term impact on debt sustainability, et cetera, of expanding tax cuts, but from the market's perspective, and this year and next year, it's positive if we get that.
What you're saying right now explains to me why yesterday, on a day of maybe relief that there wasn't necessarily another tariff announced or potential softening in some of the terms, we saw the biggest one-day rally in high-yield bonds going back to August of last year. It speaks to exactly what you're talking about, that people are betting that we are not going to get a recession and that riskier credit will do better.
I think essentially that is correct, because every time I see the headlines on imminent recession, I look at those fixed income risk assets, and as far as I'm concerned, there's cognitive dissonance. Nobody's throwing out their risk assets on the back of a recession, which, if it were coming, you would not see high yield spreads where they are. You just couldn't. And the fact is that the market participants are betting on someone coming in and easing pressure on that 10-year yield, which I think is probably not appropriate. The Fed can't do it, and despite discussions from Scott Bessent, there's an absolute limit as to what he can do unless that deficit comes in.
Okay, let's talk about that. He actually came out, and he had made a lot of noise before he became Treasury Secretary about Janet Yellen and her issuing more on the front end as being a liability and not terming it out. Then he came out and he said that he was going to keep that schedule of issuance, and the market rallied because there was a sense that he was sensitive to how issuance would end up affecting bond yields. Why do you think that's not enough at a time when that seemed to be the biggest concern for people?
Well, I think it shouldn't be the biggest concern for people. That's number one, because actually what should be the biggest concern for people is the sheer quantum of the U.S. fiscal deficit, which is enormous. And if we get any piece of the additional tax cuts which President Trump promised on the campaign trail, that deficit is set to expand further. And I see so little appetite for doing anything on what needs to be done to constrain that deficit, which would be on significant pieces of expenditure. And I'm not talking about DOGE here, I'm talking about the stuff, entitlements. That's the bottom line. We're looking at twice the level of expenditure here in the US that, in terms of the deficit that we had pre-COVID. And most of that's coming from entitlement spending. So no, I don't think that it was purely a supply issue which was driving those yields up and down.
Given the deficit as a restraint, do you think that we only get an extension of TCJA then and none of the extras that Trump did promise on the campaign trail?
That's a really tough call, because he hasn't talked as much on taxes as he's spoken on everything else, which we wish he wouldn't keep speaking about in terms of tariffs and so on and so forth. But he hasn't spoken as much. However, I think a week or 10 days ago, he did raise the idea of full depreciation of CapEx within the first year. Now, clearly that is unlikely to happen, but even a further reduction in the amount of time that CapEx can be depreciated, I think would be viewed as a positive, in part because nobody would see it as truly permanent. So you could see an immediate reaction of firms stepping in to do planned CapEx. It happened last time around because there's no true belief that under a different administration, some of these benefits wouldn't be taken away. So, yeah, I think some of them directionally probably have to happen beyond that main piece.
Some people have been surprised by the sequencing. They might also have been surprised by how other countries have responded to this, specifically Germany. Germany and Europe are about to go on a spending spree, an unexpected spending spree. How has that changed your outlook for fixed income?
So here's the thing, I think maybe a dozen years from now, we're all going to look back and say, okay, so the last fiscal non-reprobate standing was pushed down, and we all cheered. Germany was literally the only country amongst the developed, advanced economies which wasn't spending as if it was going out of style. Here's the thing, mechanically, yes, growth goes up, but the multiplier attached to defense spending is incredibly small. So it's not as if this is going to trigger a wave of structural reform, innovation, which puts Germany onto this incredibly better growth path into the, I don't know, indefinite future, which is what you'd want to see. The last thing is, I think it's highly unlikely that we're going to see it just actually being able to absorb those funds into the German economy or any other economy. It's not the flick of a switch. You can't suddenly ask Porsche to start making tanks. It doesn't happen that quickly, is all. I just think these things take time. So some of what we've seen in the reaction of the market seems to be somewhat overdone.
We don't want Porsche building tanks. It's no desire for Franklin Templeton. It's not buying the happy talk out of Germany. Thank you. Up next on the programme in the third hour of Bloomberg Surveillance, Abby Yoder of JP Morgan and more.
To succeed in Wall Street, what skills do you need? You need to be somebody that claws people in the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency. The other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
You're spoken, sorry.
My voice and my conversation, my poetry, you know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The key word we keep hearing is the word uncertainty.
You still have a lot of uncertainty out there, even after April 2nd.
There is some wait and see out there.
As we get more clarity, I think markets will be able to get on with whatever is the destination.
The next couple of months is going to be a really rocky road.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Your equity market open is 19 minutes away, and your scores look like this on the S&P 500. Positive by 0.25%, and looking to build on a two-day winning streak. On the Nasdaq 100, we're positive by 0.2%. The next stop for this market, the economic data later this morning. Consumer confidence at 10 a.m. Eastern Time. How is the consumer feeling about this moment? KB Homes is attempting to answer that question. A downside surprise on Q1 earnings on the top and bottom line, and a cut to the outlook. That stock down this morning by 8%.
And how much does this have to do with what we're seeing with respect to tariff uncertainty and just policy noise in general? And how much was this pre-existing heading into this period of time? When it comes to the home industry in particular, housing unaffordability has surged to record highs. You've seen this decline relative to the rest of the market in home builders. This goes to Neil Dutta's point. How much of this was already in the works before all of the noise around tariffs really took hold?
And then layering on top, we've got all the tariffs as well. The president in the last 24 hours teasing a lighter touch on tariffs on April 2nd.
It sounds like he's going to be flexible when it comes to a lot of these negotiations. And already we see a flurry of diplomacy happening at this moment. Today, the European Union trade representative going to Washington, D.C., sitting down with USTRs, Jamieson Greer and Howard Lutnick, the Commerce Secretary. A delegation going to India. We know India is desperate to make potentially these concessions before next week. And then a phone call between Jamieson Greer and his Chinese counterpart. So you see, ahead of April 2nd, Trump is in negotiating mode, and I think he wants to get deals done.
The best thing that could come out of this a little bit later on this afternoon, following that meeting between the EU, the Commerce Secretary, and the US Trade Representative, some kind of agreement on autos. Just avoid all of this altogether, drop your tariffs, make sure they're equal playing field, move on.
How likely do you think that is? I mean, given the animosity that's rising.
We've seen the reports in the last week of potentially the Europeans making that offer, so let's see.
If that becomes on the table, how much does that allow this market to rip that much more at a time where people say that the momentum really is shifting back to the United States, and you are seeing economic data turn more favorable when you look at some of the surprises?
We said it earlier on this morning, it's difficult to read the tea leaves down in Washington, D.C., but I think an appreciation for some of the legal constraints on what this administration can and can't do on April 2nd starting to come to the surface.
Well, that's what the FT is talking about, this two-tier approach. What can they maybe do legally with, say, a national security law to enact tariffs on day one on April 2nd? And then what do they need weeks or months to do when it comes to, say, Section 301, which we know they used in Trump 1.0 for the Phase 1 trade deal with China? So that's why potentially April 2nd we'll have clarity on what might be enacted immediately and what might take longer.
Equity futures this morning positive by 0.25% on the S&P. Coming up through the next 60 minutes or so, Abby Yoder of JP Morgan Private Bank as stocks look to add to a two-day rally. David George of Baird on recent upgrades for U.S. financials, and Joe Davis of Vanguard on why he's lowering his GDP forecast for the rest of the year. We begin this hour with stocks steady following back-to-back gains on the S&P 500. Abby Yoder of JP Morgan Private Bank writing, markets have quickly repriced to reflect increased risk related to tariffs and fiscal austerity. We still favor the US over the rest of the world and maintain our preference for software, industrials, utilities, and financials. Abby joins us now for more. Abby, good morning.
Good morning.
Good to see you. Where does that view come from? Let's build on that. The United States over the rest of the world, because we have seen some significant underperformance in the first few months of the year.
Yeah, and I mean, I think a lot of that was positioning related, right? Like you come into if you think about the backdrop of coming into this year, that was general consensus that it was, US over the rest of the world, and that was reflected in valuations, right? Valuations in Europe were a 40% discount to the S&P 500. Typically, that's like 20 to 25% discount. So it didn't take much to get it to move the needle in terms of the outperformance, right? And you saw a lot of money flow over there. there, over to Europe and China. And what hasn't happened is you haven't seen a fundamental re-rating in terms of those markets, right? So that makes them a little bit more susceptible to a pullback like what we're seeing right now because it was valuation.
Do you think they're vulnerable to the tariff announcements of the next few weeks?
Well, that's the thing. I think this was pricing in a lot of the good stuff, right? Like a lot of the German fiscal expansion. And, you know, we were getting slightly better earnings in the region, more of like a bottoming out than I would say an acceleration. And it wasn't factoring in, I think, any of the negatives as it relates to tariffs.
You think April 2nd is peak policy uncertainty, but what about the questions that remain after April 2nd?
Yeah.
Potentially if Trump still wants to be in negotiating mode. How do you think about how long-term to look at tariffs if uncertainty is going to be pervasive for 4 years?
Yeah, I mean, I think there's a scope for it to be peak policy uncertainty because obviously we're going to get incremental information, and right now I think it's just everyone's kind of operating with a blindfold in terms of the headlines each day. But what I think will be important on that day is, one, obviously the scope and the magnitude, but also the duration. Like if we get any clarity around that, I think that will be very important in terms of markets digesting.
How do you think the Fed is looking at this? Because yesterday Raphael Bostic didn't like the word transitory when it comes to the inflationary impact potentially of tariffs.
I mean, we do view it as transitory in terms of the way that we have it in our economic projections, right? We have a one-step increase in terms of, you know, this year and next year. It's just 10 basis points. And I think history would show, you know, if you go back to 2018, that there wasn't really, you know, an inflationary impulse. I think the way the Fed is thinking about it, at least as it relates to Powell, was really on the growth side, right? Like he seemed much more concerned or be willing to act as it relates to if there were a growth downturn. The bad part of that is that would take more pain in the hard data, which would probably feed through into equity markets before you see an action.
The areas that you like, I think, are really interesting. Industrials, utilities, financials, and software. Software makes sense. When you look at financials, they've taken a real hit, although they have recovered recently. And part of it is that deal making just has fallen off a cliff. There was some data that was highlighted in the Financial Times showing that the number of deals announced since the start of January is the lowest in more than a decade. How do you reconcile that with a bullish call on financials?
Well, so no, it's tough, right? Because it was a different outlook. You know, when we wrote our outlook in November, it was a very different, you know, setup in terms of we were thinking this was going to be very much like Trump 1.0, where there was going to be pro-growth policies that were, you know, first enacted. Now, I don't think that those things are changing. I don't think that, you know, the dismantling of bureaucracy or, you know, taking down regulation is off the table at all. I think there's just a different prioritization at the moment. And you're hearing that from a lot of banks, right? You're hearing that the pipeline is still there. We've gotten some announcements over the past couple of days and weeks that bode well for, I would say, the IPO market. And trading is doing quite well, particularly equity trading. So there are still things that could happen. And the deregulation is for the banks themselves, but also for, you know, the prospect of loan growth going forward in the U.S. to other industries.
One of the reasons why this is such a hard moment is that markets seem to be swayed in such massive form depending on the headlines, and yet there's some underpinning stories that are moving around other aspects of the market. When you look at industrials and utilities, I have to wonder how much you're watching what's going on in China. Some of the pronouncements out of Alibaba and questions around how much people have wagered on these sectors getting a boost from the build-out of chip centers that might prove to be maybe a little bit more ambitious than people previously thought.
Yeah, that's certainly a risk, but I think you saw that reflected in the pullback that you saw, right? These are some of the names that were down in excess of 20%, right? Well in excess of the market. And I think when it comes to utilities specifically, right, there's regulated, there's, you know, independent power producers within that index, and it's still overall a defensive index, right, or a defensive sector. And when you're thinking about the other options like a healthcare or a staples who have re-rated 5 to 8% this year, I mean, it still screens as the most attractive defensive, and it's domestic in nature, right? So keeping that in mind as well.
Where are you on some of the consumer-facing companies? Because we heard from Delta Airlines in the last few weeks that things weren't great in Q1. In the middle of February, we're hearing from KB Homes overnight that things aren't tremendous as we start to kick off selling season. Where are we for the consumer now?
So I think there's some choppiness as it relates to seasonals that are going on in January, February. You've heard a lot of comments around weather and, you know, weather-related choppiness. And there's also just, you know, from a company standpoint, like, there are market share losers, and I think those gain the headlines a lot of the time in terms of like how they did in the quarter and then their projections going forward. overall, yes, I think the consumer is softening. We had that in our projections. It's just a matter of how much they're slowing. But that did result in us taking down, our 2025 numbers just 3% to start the year, or in the past couple of weeks.
So are you pretty much ignoring the consumer confidence data that we're going to get in about 2 hours' time?
Not ignoring it, no. But, having to, like you said, though, there's idiosyncratic things that are going on underneath. And I think, like, for example, airlines are struggling, but cruise lines are doing fine, right? So you have to be very specific in terms of your consumer exposure.
We saw it with one company in the past week. Elisa's asking the right question, though. How much weight do you put on that data point now? Is there a reduced weight on that data point following what we heard from Chairman Powell last week, who doesn't seem to be putting much weight on it at all?
I mean, I don't think that you can just take it at face value and ignore it, right? Like there is a message being sent, and I think that's exactly what this administration is addressing in terms of like, we can't necessarily call it a vibe session. It might be, we're 2 years into this Fed hiking cycle, and there are real ramifications for higher rates. And so I think just, being cognizant of that risk is something that we're definitely focused on.
The Treasury Secretary himself made that point in the last week.
Yeah, this is going to be something that's really important. You know what keeps striking me, especially with Sanal Desai and then the discussion around tariffs and how that's affected the stock market. Stock market's focused on tariffs. The bond market is focused on the debt negotiations and what happens in Washington, D.C. getting passed. And I find it interesting to see these two different tracks and kind of where they meet and where they don't. Anyway, I thought of the moment.
Abby, it's good to see you.
Thank you.
Thanks for catching up with us. Thank you. And thanks for tolerating Lisa for a little bit as well. Abby Yoder of JP Morgan Private Bank, thank you. No, I'm with you. You make a really good point.
It's okay.
A couple of different things this market is focused on right now.
Honestly, you can apologize, like evergreen apology to everyone who watches.
I'm agreeing with you. Equity futures here up by 0.2% on the S&P with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Trump's tax bill is taking center stage on Capitol Hill today. Sources tell us that Treasury Secretary Scott Bessent, National Economic Council Director Kevin Hassett, House Speaker Mike Johnson, and Senate Majority Leader John Thune will all meet to discuss the reconciliation bill. The Trump administration is extending Chevron's deadline to stop its operations in Venezuela. The Treasury Department says that the oil giant now has until May 27th to stop operations. Chevron is the only U.S. oil company that's still in Venezuela. It produces about 1/5 of the country's crude output. And in the NCAA tournament, the Sweet 16 in the women's tournament is set in a double overtime thriller. Maryland beat Alabama. UConn cruised past South Dakota State. Texas took down Illinois, and USC flew past Mississippi State despite a season-ending injury to star Juju Watkins. Oklahoma also advances to their first Sweet 16 since 2013. And that's your brief, John.
Hey, Danny, thank you. Just looking at the brackets and the scores on the Bloomberg terminal. Anne-Marie still crushing it.
I'm
Good
sixth
news.
globally.
Amazing.
Third for the firm. Now beating Mark Rowan.
Are you beating Michael Bloomberg?
I am beating Michael Bloomberg.
By how many
Sorry.
points?
He's 101. I'm 106 by 5 points.
I'm looking at our charity league as well. Jim Zelter of Apollo, top of the pile, beating Mark Rowan of Apollo.
But I'm beating all of them.
By just 2 points.
Is that allowed? Is it going to be internally sanctioned?
I'm not sure what kind of fight's happening over Apollo, over the Women's March Madness. We'll find out. I think Jim's joining us in a few weeks. So we'll find out from Jim in the next week or so. Up next on the programme, the Morning Calls plus David George of Baird on his upgrade of certain US financials. That conversation just around the corner, live from New York. This is Bloomberg.
politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The opening bell, 1 hour and 15 minutes away. Equities doing okay, up by 0.2% on the S&P 500. On the Nasdaq, up by 0.2% also. Later on this morning, in 1 hour and 45 minutes time, consumer confidence in America. Another read on how the consumer feels about this economy. That's going to be an important one. And then later, Fed speak. The New York Fed President, John Williams. How much daylight is there between him and Chairman Powell following Chairman Powell's news conference last week? I don't think anyone's anticipating daylight between those two, but certainly daylight between him and what we heard from Raphael Bostic yesterday.
Can New York Fed Chair John Williams say the T word? That's my big question, because what we heard from Raphael Bostic was he wasn't even going to say the word. Absolutely not. That was not in his base case. If we get the same kind of T word, does that give hope to the market?
We've seen Williams do a clean-up act for Chairman Powell before, following a news conference, haven't we?
You think that transitory is a clean-up act?
I don't know. I just don't know if he meant to say that. I really don't. It felt deliberate. I'm with you. It felt deliberate. It just seems clumsy. Why bother? Why go there? There's better ways to describe the moment.
Why bring that back? What is the goal other than to message to, frankly, the political sphere that they kind of are watching this and taking their word for how this trajectory is going to be. So don't blame us and don't come target us. And how much is this trying to buy them some political space?
Look out for those comments from the New York Fed President John Williams a little bit later on this morning. Let's get you some morning calls. First up, Baird cutting its price target on Airbnb to 160, seeing short-term rentals stabilizing. That stock is up by 0.1%. Your second call from Morgan Stanley, upgrading Carvana to overweight, pointing to competitive advantages and an attractive entry point. That stock is up by 5.5%. And your third and final call, BTIG upgrading Capital One to buy, citing positivity around the bank's potential merger with Discover. That stock is up by 1.3%. Let's stick with the financials. David George of Baird upgrading banks, including Capital One, JP Morgan, and Bank of America. David writing, tariffs won't have a direct impact on the sector, but obviously can drive fears around credit quality and revenue growth slowing. David joins us now for more. David, welcome back to the program. Been meaning to catch up with you, sir. Appreciate the update on some of the calls. So let's start with Capital One. Let's start there because that's been in the headlines in a big way over the past few weeks. David, what do you like about that franchise at the moment?
Yeah, good morning, John. From our perspective, the weakness over the last 2 to 3 weeks around, as you mentioned, tariffs and uncertainty around policy has created an opportunity in a number of stocks, Capital One being one of them. And with the stock getting to kind of the 165 area, we felt like on a risk-reward basis, the stock was very, very compelling. And in our opinion, the Capital One Discover deal, if it goes through, is a transformative deal with significant cost synergies in addition to revenue synergies over time by enabling Capital One to put a number of its cards on the Discover network. There's a significant revenue upside potential from our perspective that is not reflected in the stock at current prices. And we think kind of on a normalized basis, Capital One can earn at least $22 to $23 a share once the deal is closed in 2027. This is a deal that will not only result in significant synergies, we think the profitability of Cap One post-close is going to improve by 20 to 25% as well. So this is, we think, one of the better ideas in the financial space and in what we think is going to be a transformative deal.
Can we address the if, David, if it closes, if it goes through? Sure. How much of your buy on that name hinges on that if?
It's a big part of it, John. Clearly, as I mentioned, this is a very transformative deal strategically and economically. If the deal weren't to go through, we felt like at 165 or so, the downside was fairly limited. We think Cap One as a standalone company can earn $16 to $17 a share, and is in a currently a very enviable capital position today, and credit is holding up relatively well also. So if the deal were to not go through, to be clear, Cap One is definitely vulnerable to the downside, but we think the upside potential offsets that potential downside risk that you mentioned as it relates to this Discover deal. But we should get some clarity, hopefully, over the next several weeks.
David, how much is this really a litmus test for the Trump administration's openness to some of the bank tie-ups that a lot of people have been hoping for?
Yeah, it is a big litmus test, Lisa, as you mentioned, and there's obviously, as you mentioned with your earlier guest, a lot of optimism around M&A broadly. We've seen a slowdown in the last month or two, given the uncertainty around tariffs. The M&A business at a number of the companies we cover, the updates have been softer, and that's a result, we think, of some of this uncertainty around tariffs. So this is a big litmus test, and we're of the view that we are on the cusp of a big bank M&A wave. We wrote a piece on that over the last month or so, and we think there's going to be a number of deals in the regional bank area over the next couple of years. And we think that we're of the view that this Cap One Discover deal is going to go through. But as you mentioned, this is a huge litmus test on this new administration, their views towards bank merger activity.
This was raised even more so last week when there were reports the Department of Justice under President Trump were taking a second look at this deal because it created an unfair playing ground or took away a competitive landscape for particularly credit cards to lower income consumers. Do you just dismiss those reports as being noise, or are there other elements that you have heard out of this administration and, frankly, the FTC under Trump that make you think that actually this could be the road ahead?
No, we obviously read the reports, Lisa, last week that I think it was Capitol Forum talked about the subprime concentration. It's important to know we don't cover Discover, but if you look at their balance sheet, Lisa, they've only got about $1 billion in subprime assets. So in a worst case scenario, if Cap One needed to sell those, it would be very negligible from an earnings impact to the extent that they had to dispose of that asset. What wasn't discussed in all of the concerns around this deal is that Discover is currently under some regulatory scrutiny. They're under regulatory supervisory issues today, and closing of this deal would eliminate that. So we think that this solves a regulatory problem, and that offsets any potential risk as it relates to the subprime issue you mentioned.
On a larger level, David, a lot of people came into this year thinking that we could see tie-ups between smaller and mid-sized banks, and that this would be the time and the political climate to do it in. So far, we have seen the number of deals announced year to date fall to the lowest in more than a decade, this according to a Financial Times report. And a lot of people are saying these deals are just iced. They're not necessarily benched completely. At what point would you change your view, your optimism that there could be some potential wave of mergers and acquisitions in the financial space? At what point in the year?
Yeah, I think that's right. I would say, Lisa, 3 to 6 months. I don't think this is going to take very long. It's important to note that we're just getting folks in their chairs. Michelle Bowman obviously was just named to and needs to be confirmed from a supervisory perspective. So I think we need to get some of the new people in their seats before we can really say that this administration is not pro M&A. So from my standpoint, at least, this is something that I think we need to give a little bit of time, and I think 3 to 6 months is more than reasonable.
David, of the banks on Wall Street, just before you go, top pick right now, is it still Bank of America?
So our top picks here, from our perspective, John, would be Cap One, as we obviously talked about. In the mega cap space, Bank of America is one that we recently upgraded. In the 6 stocks we upgraded in the teeth of the sell-off. B of A, there's been a lot of angst around Berkshire Hathaway's ownership in the stock. And as you both know, they've been selling the stock over the last several months. And we think that is really just to get under the 9% threshold so they don't have to report on it as frequently. And we're of the view that this provides an opportunity, particularly when the stock got in the low 40s. We think about Bank of America as a $48 to $50 stock, and that's kind of 10 times what we think a normalized earnings power for B of A would be in that $4.80 to $5 region. So B of A, we think, looks really good and is our favorite mega cap name right here.
Outperform rating, $50 price target. David, appreciate your time, sir. It's good to catch up. It's been too long. David George there of Baird on the US financials. Pleased you went there on M&A and capital markets activity. Clearly, things haven't developed in the way people thought they would. Is it delayed or derailed? I think a lot of people still assume it's just delayed and not derailed. But if you go through the reasons why at the moment, market volatility, antitrust concerns, 1 and 2 weighing on 3, CEO confidence. Now, you can do something about market volatility, maybe that fades in the next several months. Maybe that contributes to better confidence levels for the C-suite. But antitrust concerns, I think we've still got to work through them. Based on what we've heard so far, there's almost a continuation of what we saw in the Biden administration into the Trump administration, and this is something you warned about repeatedly before the election.
That's because when it comes to the individuals surrounding Trump, there's a lot of populist thinking when it comes to antitrust, and you have to think of what J.D. Vance said about the Biden administration. You cannot overemphasize the one person he thought was doing a decent job was Lina Khan. So that is why you see some of this continuation, especially when it comes to big tech, but that already started in Trump 1.0.
If you're just joining us, welcome to the program. Equity futures here positive by 0.2% on the S&P. Later on this morning, consumer confidence at 10 a.m. Eastern time. Joining us to discuss, Joe Davis of Vanguard and Krishna Mamani of Lafayette College. Live from New York, you're watching Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
60 minutes away from the opening bell, equity futures here positive and near session highs, up by 0.25%. Let's get to your morning moves and cross over to Danny Berger for more. Hey, Danny.
Hey, John. It's a tough pre-market session from the home builders this morning, and that's because of KB Home. It's off of the lows of its pre-market session, up down nearly 6%. It missed on the first quarter and cut its 2025 outlook, saying that the spring season demand has gone off to a slow start. There's affordability issues with consumers, and that macro and geopolitical uncertainty means people are holding back on purchases. Now, to the upside, we have Cloudflare this morning, the technology company, up 6%. A rare double upgrade from Bank of America, who says that it has a differentiated AI product. It goes from a $60 price target to an $100.60 price target. That is a big upgrade. Finally, rounding things off with some earnings this morning, McCormick, this is the spice maker. Their sales were flat. That is a miss versus expectations, so they're down more than 3%. The interesting thing was the commentary about tariffs here, though. They said, like so many companies, they're not including it in its 2025 outlook because of the uncertainty, but it does say, John, what price increases it might see. It plans to offset those by cost cuts and, importantly, price adjustments, suggesting that McCormick plans to pass those prices on to the consumer.
Danny, thank you. Earnings season is going to be a big deal. Ramps up with the banks on Wall Street in a few weeks' time. Lisa, JP Morgan on April 11th.
What do they do with their outlooks? We were talking about whether they withdraw them altogether because there is such little clarity. Right now, we have heard from a number of retailers that have been lowering their expectations for the full year just based on what they know about tariffs. They're going to have more clarity when earnings season kicks off.
Got an update from Dow in the past few weeks. They'll report a fuller earnings package on April 10th. So look out for earnings in a few weeks' time. Stay side. We need to look out for the economic data later on this morning. US consumer data due at 10 a.m. Eastern time. And Michael McKee has more. Good morning, Mike.
Good morning, John. Well, the consumer confidence data that we've had from the University of Michigan and the Conference Board have disappointed and raised red flags about the possibility of an economic slowdown. We get an update on the Conference Board numbers today that, according to economists, will put us into territory we haven't seen since the height of COVID, January of 2021. If the blue line there falls as far as we think today to 94, it's really going to be another signal that consumers are getting very, very nervous. Now, of course, you've been talking all morning about watching what they do, not what they say, but it is going to be very interesting to see what they have to say about their buying plans, which is a big part of the consumer confidence survey from the Conference Board. We also get new home sales, but they're only for February. You saw Danny talking about home builders shares. This isn't going to help one way or another because it was during a month that was very cold. We might see a slight rise, but it isn't going to tell anything about the spring selling season. And I'll pass along this one number here, only because it's one of those catch your eye numbers. The Philadelphia Fed, we talk about their manufacturing index. They have a non-manufacturing index that was just out. It fell from negative 13.1 to negative 32.5. We don't have a long history with that. Can't tell you exactly what it's going to mean in the long run, but it does show on the business side a big lack of confidence.
The data gets murkier. Mike McKee, appreciate the update. Expect more from Mike throughout this morning, particularly on consumer confidence from the Conference Board. Getting an understanding about anxiety around the labour market, I think, is going to be tremendously important as well. If you're worried about the second round effect of tariffs passing on higher inflation, that's got to be key.
And we did hear notes of that within the University of Michigan sentiment survey. Say what you will about its accuracy or its survey methodology, but people did cite their concern about that. You also look at the quits rate. That's going to take on a bigger import than, say, even the JOLTS number, because that will give you a sense of how much confidence people have to quit their jobs and move on.
We've seen a lot of downgrades to economic growth, including from JP Morgan and Goldman Sachs. Vanguard is now slashing its 2025 GDP forecast. Joe Davis of Vanguard writing, uncertainty around tariffs immigration, and other policy is likely to weigh on growth in 2025. Real-time signals point to a material slowdown in GDP growth in the first quarter. Joe joins us now for more. Joe, welcome to the program. It's good to see you. So set us up. How did you come into 2025? What kind of numbers were you anticipating, and what are you looking for now?
Well, we were closer to trend going into the year, and again, that was clearly a downshift from the strong performance we saw in the U.S. in 2024. So there was already, we were assuming some tariff legislation would pass. It's been more of the uncertainty around policy that has crimped our forecast from the investment side and from some of the consumption side. And so I think, you're seeing that in other parts of the market. So it's really the uncertainty tax that's led to a more significant downgrade, at least in the next several months.
Joe, a number of guests have come on the show and said, so far the uncertainty tax could be easily reversible, and that if there is some certainty imbued into markets, that would go away and the deal activity would come roaring back. Do you disagree?
Yep. I don't disagree. Again, it's what history shows is that uncertainty, although very unpleasant, does have a half-life, and it will start to fall in part because of the second round effects, and you'll have financial volatility, and potentially that'll affect policymaking decisions. But we're in for some turbulence here. I think we've seen that in the financial markets. We've seen that in some of the soft data. We're going to see that a little bit in the hard data. But again, we do not have, to be clear, we do not have recession as a baseline. I think it's going to be important for investors to really dissect the signal from the noise. It's clearly a downshift, but I do not see that dropping below zero for the next 6 months.
Raphael Bostic yesterday, sitting down with Mike McKee, talked about when he goes out to businesses, two things they've told him. One, they see business having an uptick, but at the same time, they also think they need to raise prices. And he says the biggest question for 2025 is how consumers manage through those price levels. Do you think consumers are able to deal with higher elevated prices?
Well, I think it's really bifurcated just consumer market. We have, some with lower incomes, which are really going to struggle. They were already on a weaker footing going into 2025, and I think that will continue given the stagflationary impulse. The higher end consumer really will depend on the strength of the labor market, middle income, higher income, which has really been the strength of consumption over the past 12 to 18 months. Again, given our baseline, we're going to have turbulence here, but we do not have a recession. That would be the high-end consumption and businesses rolling over in the labor market. That's just not our current forecast.
Joe, how much do you take a look at the soft data and factor that into your expectations going forward at a time where a lot of people have been saying, well, it's unclear whether that actually will trickle out into what we see from the government?
Well, I think it's important to look at all data. I mean, hard data is a little bit more tangible by definition than soft data, but soft data is not worthless. I think it also speaks to sentiment, which again, you have to overlay just the uncertainty itself, which there's quantified measures of something that seems esoteric. So I think you look at all of them, and that's pointing to softness for sure, but it's also not pointing to that we are going into a significant recession. At least that's not in the data right now. So that's where the next 3 months are really important from a market and economic perspective.
There's been an interesting shift in psychology over the past 2 months. Heading into this year, people expected that tariff announcements would hurt the rest of the world more than it would hurt the United States. And right now, the rest of the world seems to be shrugging off some of the tariff threats coming from the United States. And investors seem to be suggesting that the U.S. will experience the greatest amount of pain. Do you agree with that from an economic perspective, that the U.S. may shoulder a greater proportion of any kind of slowdown in the economy from tariffs than, say, Europe and China?
Well, not necessarily. I mean, again, I think if you look at all countries, obviously, if you were talking about tariffs on autos for Canada and Mexico, given the integrated supply chain, there would be a significant hit to those economies. For Germany, again, you have cross currents going on in the global economy, both right now and for the next year or so. You have the focus on deficits, you have the government spending. We're seeing that different dynamic in the U.S. versus, say, Germany. And then you just have this greater competition between the U.S. and China, and the desire for the U.S. to have a little bit more manufacturing here at home. So all of these forces are coming at the front at the same time. And so you're going to go through turbulence just because of those intersection of those forces.
And the Fed has got to attempt to navigate all of that, Joe. So let's finish there. In the next 20 minutes or so, we'll hear from two core members of the Federal Reserve, one, Governor Kugler, in the next couple of minutes, and then shortly after 9 a.m. local time, 9 a.m. Eastern time, we'll hear from the New York Fed President, John Williams. Joe, I just want you to reflect on what we heard from Chairman Powell last Wednesday and whether it led to you asking any questions about the incoming Fed speak, what you'd like to hear, where you think maybe there were some spaces that they need to fill.
I think they are wait and see and risk management. I would be also, which I was happy to see, not in an urge or a rush to cut rates, because you do have this stagflationary impulse, and we're just off of 3 years of inflation well above target. So I think they're being prudent here. I think they are worried about some weakness in the labor market should it emanate, and so I think they're prudent in doing a wait and see approach.
They're very much in a wait-and-see mode. Joe Davis there, of Vanguard on the Federal Reserve. More Fed speak, Lisa, coming up through the next 20 minutes or so.
I want to know whether they think transitory is still in effect. I want to know the T word. Will they say it? Say transitory. Just say it. No, I won't say it.
Is that what you want them to say?
Well, no. This is what I think is the most interesting.
Do you really want to play that game again?
Well, honestly, this is where we're going. I mean, the fact that Raphael Bostic wouldn't even say it tells you a lot about where he is. And given the fact that T word has real power over this market, because let me tell you, people took that and they ran with it. And that's, I think, really what people took away from that news conference.
It was a really interesting exchange with Michael McKee and the Atlanta Fed president just yesterday. Mike, just to bring you back into the conversation, there are other Fed officials we're focused on this morning.
Yeah, Anita Kugler just out with headlines speaking to the Hispanic Chamber of Commerce, suggesting that she is watching the consumer sentiment numbers closely, particularly for inflation expectations. She said she's paying close attention to the acceleration of price increases and higher inflation expectations, especially given the recent bout of inflation in the past few years. She's tying it back basically to the fact that consumers are probably going to be hit with the tariffs. And that is something that the companies who are talking to the Fed people are telling them is going to happen. They're just going to pass it right along. She notes that inflation in some categories is going up again, and goods inflation has accelerated. So she's a little bit worried about what might happen, and that's going to put some downward pressure on the idea of 2 rate cuts. John Williams coming up top of the hour, but it's opening remarks at a banking conference. I wouldn't expect too much from him, but as these Fed officials come out, we are seeing much more caution on their part.
Interesting. Mike, thank you, sir. Michael McKee with the latest on the Fed speak coming from Fed officials in the past few days and what you can anticipate for the next 20 minutes or so. With us around the table, Krishna Mamani of Lafayette College. Krishna, good morning. Good to see you.
Good morning.
I want to reflect on what you said last time, back in February. You said you'd rather be in bonds than stocks. Since then, stocks are down. Bond yields are lower. You're still in that position.
I think so. If you kind of evaluate the situation right now, the risk of the economy accelerating with all sorts of things hanging over the economy is pretty small. On the other hand, there's a real possibility that we slow down. So in that environment, being in stocks or being overweight stocks relative to bonds, I don't think makes much sense.
Especially because you say 5,600 is the new 6,100 on stocks, and that's a pretty bearish outlook considering that most people on the street are seeing 6,000 or above as the likely target for year end.
Well, so the point I'm trying to make is we have a new trading range. We are not going back to all-time high, and if we do go back to all-time high, we are not staying there. I think given the level of uncertainty that you have in the market, expecting the same valuation on tech stocks that you had before that uncertainty, I think doesn't make any sense. If earnings growth was going to accelerate, then that would be a different issue. That's not the case anymore. So the point I'm trying to make is get used to a lower trading level. It's not the end of the world. It's down, let's say, 5, 7, 10% point from all-time highs. It's a decent level.
You know, it seems as though the uncertainty tax around tariffs affects stocks. It seems like bond markets don't care. It feels like on the margins, maybe high-yield bonds and maybe some of the spread market credit. But when it comes to government debt, it's sort of almost a comfort. It can kind of suppress growth a little bit, potentially down the line. They're paying attention to the budget. Do you think that that's the right way to look at it?
Well, so they're not paying attention today. And the reason they're not paying attention today is because there's enough momentum in the economy to continue to sustain the growth level that, as Joe was saying, he's not looking for a recession. He's looking for sub 2% type growth rate, which is pretty decent given inflation level. 4% on 10 years makes a lot of sense. However, if things slow down, if this continues and this continues till the end of the year, I think things will slow down. Things will slow down on all fronts, consumption and investment, and therefore bond markets will probably react at that point. I think the other thing to remember in this context is bond markets are going to react far earlier than the Fed. Fed is out of the picture for all practical purposes. Because of inflation, they can talk transitory, whatever. They're not cutting anything, and but they're not raising rates as well. So they're completely out of the picture. And the move will be on the bond market's court to see if the economy has slowed down enough where stagflationary issues that they're worried about today kind of fade away. We are talking about slow growth and a potential recession. Not today. Towards the end of the year.
This is key. Let me pick up on that. Last week, not hiking was bullish. I want to understand when not cutting is bearish. That's when the story starts to change, because what they've communicated to us is that they've lowered their growth expectations but haven't added to cuts. Now, the market ignored that because the market focused on, I get it, they're not hiking, that's bullish. When do we get to a point when the story starts to change?
Well, so I think you have to see potential slowdown in the economy. And I think you're seeing signs of that, but the momentum is enough for us to kind of continue down this path for at least a few more quarters. So if you see any of that, that's probably coming at the tail end of this year rather than middle of this year.
What do you think would convince people it's here? It wasn't Delta Airlines, it's not KB Homes, it's not the sentiment surveys. What do we need to see?
Employment. At the end of the day, what drives consumption drives the economy, and what drives consumption is employment and income growth. If you see significant slowdown in both those fronts, I think the bond market would have its day.
Regardless, you are still more bullish on bonds than stocks, correct?
Yes, yeah. Again, I'm not bullish on stocks. I think right now we are in a trading range. But if I had to put $1, I would probably put it in bond market rather than equities at this point.
So is it this idea that you are going to see some sort of deceleration in growth that you're expecting and actually a big rally into the bond market, or is it just a hiding spot? It's a distinction.
Oh, absolutely. If it was just a hiding spot, you would be rather in cash than bonds. So, because you earn comparable yields. So it's really about the expectation that with the level, given where we are in the cycle, and given the kind of kneecapping that we are going through from a policy standpoint, I mean, that raises the risk of a potential slowdown quite meaningfully. And that's the reason to be in bonds rather than equities.
April 4th, the next payrolls report, it's going to be the big one. Going to be waiting for that. And if it's weak, people will really think things are very weak.
And if it's strong, people will say, well, it's not being reflected yet in the data. So we're going to be on repeat with this story until we get some sort of concrete evidence one way or another.
That's where we are right now. Krishna, it's good to see you. It's great to catch up. Thank you, sir. Krishna Mamani there of Lafayette College with an update on stories elsewhere. Let's get your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Moments ago, the White House responding to Atlantic editor Jeffrey Goldberg, who says he was added to a signal text group where top U.S. officials discussed plans to bomb Houthi targets. Press Secretary Caroline Leavitt saying on X, quote, Goldberg is well known for his sensationalist spin. No war plans were discussed. No classified material was sent to the thread. Leavitt adding that the White House is looking into the incident. President Trump has issued an order allowing a 25% tariff on any country buying oil and gas from Venezuela. It cuts a major revenue source for Venezuela as the country's dispute over immigration. The tariff also puts pressure on China, which is a major purchaser of Venezuelan crude. Elsewhere, OpenAI is expanding the role of its chief operating officer, Brad Lightcap. He will now oversee day-to-day operations, including international expansion and partnerships with firms like Microsoft and Apple. The company's CEO, Sam Altman, is shifting his focus to the technical side, including guiding research and product efforts. And that's your brief, John.
Danny, thank you. Thanks for this morning. Appreciate it. Up next on the program, we'll head down to Washington, D.C. and catch up with Bloomberg's Tyler Kendall. A full schedule in the nation's capital, including some negotiation between the EU's top trade advisor and the United States. We'll get to that in just a moment. Live from New York, you're watching Bloomberg TV.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equities firmer here, up 0.25% on the S&P 500, up by 0.2 on the Nasdaq 100. Some things to look out for as we work our way towards the opening bell at 9:30 Eastern Time, about 39 minutes away. At 9 o'clock, you will hear from the New York Fed President John Williams. At 10 a.m., consumer confidence numbers. Later on this afternoon, 2 p.m., President Trump signing executive orders. Wednesday, durable goods. Thursday, GDP plus another round of jobless claims. And on Friday, core PCE and another read on the consumer, this time from UMich Consumer Sentiment, to close out the week. Elsewhere, high-level trade talks set to begin in Washington later on today. Bloomberg's Tyler Kendall joins us from the White House for more. Tyler, just how high stakes are these meetings taking place in the nation's capital this morning?
Incredibly high stakes, John, considering that the European Union has really been the focus of much criticism from this White House, whether that's on defense spending or getting to the negotiating table on trade. We know something tangible this White House would like to see is dropping tariff barriers when it comes to U.S. auto imports. But we also have to keep in mind these discussions are going to talk about those non-tariff barriers as well when it comes to value-added tax and digital services taxes. I'd also point out that later today there is going to be a big meeting between Treasury Secretary Scott Bessent and Republican congressional leaders about the way forward on the fiscal agenda, that tax cut plan. We are going to start to hear the rhetoric really dovetail about tariffs as a revenue raiser as they look ahead to that broader growth agenda that they are trying to push when it comes to the tax cuts.
Tyler, appreciate the update. Tyler Kendall in Washington, D.C., outside of the White House. That should allow us to have a discussion about the fuller policy mix and not just one dimension, one element of it.
Exactly. Howard Lutnick, Jameson Greer really taking the front foot when it comes to tariffs, which we're going to get at least some little bit of clarity next week. And then Scott Bessent and Kevin Hassett working with Congress to make sure that they can get this reconciliation bill, extend TCJA, and then maybe even more what the president promised on the campaign trail through Congress.
I want to understand the team of rivals and how much different people are pushing for different things and whether there actually is a cohesive plan that comes together with a clear directive. Right now, people are still wondering where the nodes are. Is it to raise revenues? Is it to rejigger trade alliances? Or is it to actually reduce tariffs with some sort of negotiation, particularly with the likes of the European Union?
They've thrown a lot against the wall, haven't they, in the last few months? I would just say this. A lot of indications in the past couple of days that Jameson Greer, the US trade representative, is taking some control of the situation. I think some of the comments you've heard in the last 24 hours, including the reporting coming from the Financial Times earlier on this morning, an indication that there is a renewed perhaps refreshed appreciation for the legal constraints around some of these issues going into April 2nd?
Well, he's the legal mind of all of this. He's a trade lawyer. He worked under Ambassador Lighthizer, who really was the genius, if you would say, behind Trump's tariffs, if you were on board with them in Trump 1.0. So he's looking at actually how do you do this legally so it doesn't end up in courts. And we've had reporting that he's been the one that wants to kind of rankle back some of this control. Notice he's having this meeting today as well with the Europeans. He's also getting on a call this week with his Chinese counterpart. So I think a lot more weight is being placed on him.
Getting a better understanding of the legal framework for how to deliver some of these policies, I think, gives you a better idea of what you might see and might not see in early April.
Which is the reason why people are expecting a several-phase type of inquiry, where you get some that the president can place under IEPA, and then you have others that are going to be more of an inquiry. Again, it's not the end of uncertainty, but I love what Abby Yoder said. It's peak uncertainty just because then we have some details and we're not just completely blindfolded. So that's where we're at.
And once we get clarity, is that a good thing or a bad thing?
That remains to be seen, and I think it's an excellent point.
It's going to be big for the economic data. A little bit later on this morning, 10 a.m. Eastern Time, another read on U.S. consumer confidence. And U.S. consumer confidence, it's been heading in the wrong direction based on several surveys over the last few months. Will that change later on this morning at 10 a.m. Eastern Time when we get that data point? To react to it tomorrow, a fantastic lineup. We'll be catching up with Max Kettner of HSBC, who this morning downgraded U.S. equities, high-yield credit, and investment-grade credit to underweight. He joins us tomorrow morning. Don't miss that. We'll also catch up with Chris Ma of Ocean First Bank, Tony DeSpirito of BlackRock, and Sabajara Japa of SocGen. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and Radio from Tennis Channel. Magda Linette clinched her biggest win of the season as she took out number 3 seed Coco Gauff in straight sets to reach the quarterfinals. Linette taking full advantage of a poor performance from the American, who fired 12 double faults and 42 unforced errors in the loss.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytical math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Futures actually gaining this morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Sonali Bassett. Katie Greifeld is on assignment, and Bloomberg Open Interest starts right now.
Coming up, Tesla's shocking numbers. Elon Musk's EV behemoth posting another set of disappointing sales numbers. Plus, Trump's tariff tension, markets on the edge as the president delivers another surprise ahead of that April 2nd announcement, and division emerging on Wall Street. UBS and HSBC see more pain ahead for U.S. equities, while other strategists start to see signs of a resurgence. Let's take a look at where the markets are trading. As I said, we do have futures gaining. We've been looking at a relatively tepid trade this morning after the gains that we saw yesterday. But right now, S&P futures up 0.2%. As we get closer to that open, you can see the 10-year yield, little change, but about 435. So the yield steadily rising up from the 420 level. Some of the stocks we're watching today are focused on AI as senior foreign officials and tech execs push the White House to roll back curbs on semiconductor exports. NVIDIA, you can see right now trading down. It's only 0.2%, but when it is an almost $3 trillion company, that makes a big difference at the index level. Sonali?
Says something about sentiment, too. I want to talk about another stock with very strange sentiment. Of course, we've seen significant declines. Tesla is kind of wavering in the pre-market, is now up. But look at the data here. This is what investors have been watching. In Europe, these are registrations, and they have dropped for 10 of the last 12 months as competitors gain market share. Now, the other problematic stat about this is that it's dropped a little more than usual, too. Matt,